Good morning, everyone. It is my distinct pleasure to welcome you all to this esteemed seminar on global taxation on behalf of the Management Committee. We are thrilled to have you such a distinguished speakers, experts, and delegates gathered here today for what promises to be an insightful and engaging discussion. A special welcome goes out to the speakers, distinguished speakers. We are truly honored to have you here with us today. Your expertise in this field of international taxation is invaluable, and we are excited to hear your perspectives, insights, and innovative solutions to the global challenges in taxation. Your contributions will undoubtedly spark meaningful dialogue and enrich our understanding of critical subject. To all the delegates present here, I thank you all for joining us. Your participation in this is a testament to your dedication and staying informed and engaged with the evolving landscape of international taxation. We encourage you to actively engage with the speakers, ask meaningful questions, and take the full advantage of the wonderful opportunity to learn and network with the peers and professionals present here. Thank you one and all. Again, I welcome the speakers to the podium. I request Chairman to welcome the speakers, to escort the speakers, and please hand over a floral bouquet to them. I call upon the Chairman to speak a few words for the occasion today.
Good morning, esteemed members, respected CAS Krishnan sir and then Asoori sir, and all my dear managing committee members. Actually, last week we had a 2-hour session on international taxation by CAS Krishnan sir, and then our mentor, CA Rajgopal sir said, ಇದೇನಪ್ಪ ಇದು ಒಂದು ಫುಲ್ ಡೇ ಪ್ರೋಗ್ರಾಮು ನೀನು 2 ಅವರ್ಲಿ ಇಟ್ಟಿದೆಯಾ ಅಂತ ಕೇಳಿ ಹೇಳಿದ್ರು. Immediately I went and requested Krishnan sir. Sir said, why not, I'll do definitely. Please let me know the dates. And then today he was preoccupied actually. Because of our request, he has accepted that. And then thank you so much sir for being with us, and then Asoori sir also. Without taking much of time, I mean it's already, we are 10 minutes late. We'll start with the inaugural session. Thank you.
Thank you, Chairman sir. So, as a tradition, we start with the lighting of the lamps. May I call upon all the MC committee members to join us for the lighting. Post the lighting of the lamps, we have a motto song. Please raise that, sir. Thank you.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रदब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Thank you all. Yeah, may I call upon Vinod Garg to introduce the speaker for the first technical session.
Namaste. Good morning, everyone. It is my pleasure to introduce an accomplished professional in the field of taxation and finance, someone who has demonstrated exceptional expertise and dedication. Today, we have the privilege of learning from the experience of CA.Varshith Asoori, a distinguished chartered accountant. CA.Varshith Asoori is an experienced chartered accountant, cleared his CA in 2008, 2016, and he's having experience of 8.5 years. Previously, he was worked with the ENY, where he played a key role in the computerization and developing the investment and operational structure for international clients. Currently, Varshith is working as a senior manager, taxation in the HNI taxation division at Suresh and Company and Co. Chartered Accountant. He specialized in working with high net worth individual, providing advisory, structuring, compliances, and litigation support on taxation and regulatory matters across the range of transactions. His expertise extends to global and the cross-border transactions advisory, where he assists clients in navigating the international tax laws, optimizing the investment structure, and ensuring regulatory compliances across jurisdiction. With this brief introduction, I over to CA.Varshith Asoori.
Hope everyone is doing well. I'm privileged to stand here and deliver this keynote on the global taxation of individuals. Firstly, I thank the opportunity given. My grateful thanks to Mr. Manjunath sir. I'm very honored to give me this opportunity. And I'm also honored to speak as a speaker alongside Mr. Krishnan sir. It's a privilege for me to be here. Coming to the current topic, which is global taxation of individuals. So I'll briefly talk about on why is it important to us for learning this topic or knowing about the subject here. Because if you look at the current economy, the borders are getting thin when it comes to employment or investments. So there are individuals who are traveling across the borders for employment. At the same time, India is also becoming an employment-friendly jurisdiction where people are actually traveling from abroad to also work in India. So the trend is increasing in the way where people are looking for opportunities across the globe when it is coming to the employment. For example, there are increase in the economy or ecosystem of the individuals who are actually working for MNCs by being in India. At the same time, the culture of remote working is also going up. So currently today, if a person is working for a company, it is not essential that he needs to be there at the physical place of employment of the company. He can be working from anywhere. In this circumstances, the taxation rules or interplay of taxation between more than one country is essential for him to plan his taxes effectively. Otherwise, there is a nuance of paying tax in both the countries, whereby his income is taken away by the taxation, which is doubly taxed for him in both the countries. Given this, it is important for us as a professionals to advise our clients on how do they plan their taxes well, or how do they structure their residence well, so that they optimize their taxes. At the same time, they achieve their objective of working with more companies or working across jurisdictions whereby their potential or talent is not restricted. So with this brief introduction, I would like to get into the topic. So currently, how I have planned is the first part of the session, which is pre-T session. I'll be covering on the basics of tax residency rules, just to refresh our memory, as well as get into the intricacies of how the recent changes in the residency rules have been taking place, and what Indian government or Indian tax authorities is aiming at on plugging in the loopholes in the residency rules. At the same time, I would also get into how the income is taxed for Indian residents in case of their global income. At the same time, how Indian income is taxed for foreign residents if they are earning income which is sourced in India. So to start with our first topic, tax residency rules. In this, I would like to cover these three aspects mainly. One is determine the residential status of an individual with respect to India. At the same time, introduce two more topics, which are called as a residence of a stateless person, as well as how residence is determined in case of a person who qualifies as a dual tax resident. So let us briefly look on residential status, which we all know that Section 6 of the Income Tax Act talks about the residential status. So in Section 6, in the subsection 1, there are two conditions given, which talks about how residential status shall be determined, which is based on the number of days stay. As we all know, there are the two conditions are, first condition is the person should stay for 182 days in India. So if he stays for 182 days in India, he will be treated as an Indian tax resident. And there is another condition, if a person stays even less than 182 days also, there is another condition in which if he satisfies, he will become a resident. So that is 60 days in the current year plus 365 days in the 4 preceding previous years. We all know that if any person satisfies one of these two conditions, he will become a resident. But there are other conditions also which determines whether he is an ordinary resident, not ordinary resident, etc. We'll come to that. So before getting into it, one is 182 days, which is a clear condition. If he stays for 182 days, he will become a resident. But the second condition has few more additional exceptions. For example, this 60 days is a very short-term period. So if a person stays for only 60 days also, but if he satisfies the conditions of 365 days in the 4 previous years, he will be considered as an Indian resident. But the exceptions are given in case of 3 situations. If that person is an Indian citizen who is leaving India as a member of Indian crew, where he had to leave outside India, in that case, this 60 days is given a relaxation to 182 days. At the same time, even if a person is living in India for employment outside India, so here the exception is given for an Indian citizen. If as an Indian citizen, if he is leaving India for employment outside India, then the condition is relaxed to 182 days. One more point here is, if a person is leaving for employment outside India, practically we should also ensure that he should have a valid offer letter outside India, and also he should have an employment visa on which he should be living outside India. Because there can be a practical difficulties if a person lives outside India on a different visa, whereby on that visa if he gets employment outside India, so it can be tricky to prove to the income tax authorities whether when he was leaving India, was it for employment outside India or was it for any other purpose? Because as such, if it is not an employment visa, the tax authorities could question the intention while leaving India, whether it is for employment outside India or not. So from a practice perspective, it is important for us to advise our clients, if a person is living outside India for purpose of employment, it is better to get an employment visa and leave India using the employment visa. And the third exception was, if in case of an Indian citizen or person of Indian origin, both of them are covered. So in this case, if he is coming to India, being outside India on a visit to India, even in that case, the relaxation is given to 182 days. Because this is intended at a people who are already staying outside India, but they are coming to India, say visit their family or for any other purposes, etc. Then also it is relaxed from 60 days to 182 days. But however, there have been circumstances where people have been managing this 182 days stay such that they will not get the residential status in India. They can try to maintain the non-residential status in India. So to plug in that loophole, tax authorities have introduced one more amendment to that subclause, saying that in case of an Indian citizen or a person of Indian origin, if he is outside India and coming to a visit in India, then that 60 days condition is relaxed to only 120 days if he has Indian sourced income, which is other than foreign sourced income, Indian sourced income more than 15 lakh rupees. At the same time, if his Indian sourced income is less than 15 lakhs, then the condition stays same. It is 182 days. But only if it is less than 15 lakhs, that 182 days will apply. If it is more than 15 lakhs, it is only 120 days, which means if a person being outside India is coming to India, if he has any Indian investments, whereby he is getting Indian income more than 15 lakhs, he should manage his stay such that his stay in India should not exceed 120 days. Because if he exceeds 120 days and he also meets that condition of 365 days in the 4 previous years, then he will be deemed to be a resident. So even any non-residents, if they are planning to come to India, they should first evaluate do they have income sources. If the income sources is less than 15 lakhs, then they have to manage their stay such that it is less than 182 days. But if their Indian income is more than 15 lakhs, then they have to manage it within 4 months, which is 120 days. So in summary, the condition says 182 days, it's a straightforward rule where the person becomes a non-resident in India. But in case of people who are less than 182 days, then they have to look at the other conditions, which says that if it is it is a normal case, then 60 days. If it is a case of where he is leaving outside for employment, then again it's 182. But in all other cases where people being outside India but coming to India for visit, they should see if their Indian income is less than 15 lakhs or more than 15 lakhs. If it is more than 15 lakhs, then they are liable for a residence rule even if they stay for 120 days. If not, 182 days. So whenever we are advising our clients, it is all the more important now, if a person is a non-resident but coming to India, we have to keep track of whether the number of days stay in India is being tracked actively, whether that is more than 120 days or not. And if we are able to track that, then we can advise them that if your income is less than 15 lakhs, then you are free to stay for 182. Otherwise, you should manage your stay such that it is less than 120 days. If not, you should structure your income sources in a way that your income tax in your hands should be less than 15 lakhs if you have to stay for more than 120 days. So this is a kind of practical approach that we can adapt with when we are advising our clients in terms of how do they manage their stay in India, especially to avoid becoming resident in India. So this is all about the basic conditions where we evaluate in the first place whether that person qualifies as a resident or a non-resident. But there are some additional conditions to determine whether he will qualify as a RNOR or not, which is resident but not ordinarily resident. So here 2 more conditions are given, which talks about if a person first, if he qualifies for a basic condition and he is determined as a resident, then we look at this additional conditions. So these additional conditions, I have put it in a different way so that it's easy to evaluate. So even if a person satisfies one of these conditions, he will become a resident but not ordinary resident. In all the other cases, he will become ordinary resident. I have tried to put it in a different way from the what is mentioned in Income Tax Act. So here, first we evaluate the basic condition, where if he satisfies a residential condition of 182 days or the 60 plus 365, etc. Once either of the conditions is satisfied, then we come to here to check whether that person is eligible to become whether a person is actually a non-resident for at least 9 out of 10 preceding years, or he should have stayed less than 729 days in the 7 preceding years. If the person after becoming a resident satisfies either of these conditions, then he can maintain his residential status as RNOR. Otherwise, he will become an ordinary resident. So in fact, to put it in a different perspective, let's say a person being non-resident for many years is coming to India. So let's say he comes in during 24-25, he comes to India during December 2024. So for him, if we are evaluating or advising on a residential status, for 24-25, he will directly become a non-resident because his number of their stay is going to be less than 182 days. However, for the next 2 years, because he has been outside India for a longer period of time, then we can say that he will be a non-resident definitely for all the 10 previous years. So for the next financial year, by default, he will become RNOR provided he continues to stay in India. For the 1 more year, let's say financial year 26-27, for that year, he will still qualify for that first condition of 9 out of 10 preceding years. So he can be a RNOR for 26-27 also. But for 27-28, he will not be satisfying the first condition. But then we can look at the second condition, whether that 729 days is satisfied or not. But if that's, since he is staying for 2 continuous years, 26-27 and 25-26, and also 4 months in 24-25, that 79 days also is breached. So he is not satisfying either of the conditions, whereby he will become RNOR only for 25-26 and 26-27, but not for 27-28. If I have to put a formula to this, we can say if a person has been staying outside India for more than 10 years and he is returning to India, For the year in which he is returning back, we can evaluate based on the number of day status. Post that, at least by default for 2 years, he can continue to be a RNOR. Post that, we can evaluate whether he will satisfy that 729 days condition or not, and then decide whether he will be an RNOR or ROR. But by default, most of the cases, or 99% of the cases, where the person has been outside India for more than 10 years and but returning to India, he has a high chance of becoming a RNOR for the 2 years following the year in which he returns, provided the year in which he returns is a non-resident. Later on, for the next 2 years, he will become a RNOR. After that, he has to pay taxes on his global income because he becomes an ordinary resident. So what is the advantage of a person becoming RNOR? So as long as the person stays RNOR, only the Indian sourced income is taxed. The foreign sourced income is not taxed. Let's say a person who is a non-resident and he has a eligibility for claiming to be an RNOR for the next 2 financial years. From a practice perspective, we can advise him saying, let's say he has investments in foreign stocks, mutual funds, etc., where he has a good amount of unrealized gains. So if the gain gets realized, once he becomes an ordinary resident, he has to pay tax in India because if he is an ordinary resident, his global income is taxed. But during the years when he is RNOR, even if the gains are realized, because the gains are earned or sourced outside India, he is not required to pay tax in India. So considering this, we can advise our clients who are returning from staying outside for many years and returning to India, we can advise them, say, to harvest their gains in the period where they are non-RNOR so that they can avoid the Indian taxation part of it, and only the income that they earn post they becoming ordinary resident can be taxed in India. So this is a way where the foreign residents, where the income abroad can be avoided from Indian taxation, but they have to pay tax in the respective jurisdiction where it is taxed. Let's say in case of Singapore or Dubai, where there are no capital gains taxation, if people are returning from those countries to India, we can advise them saying in the 2 years where they become RNOR, they can actually harvest their gains before they become resident in India, and so that only the additional or incremental gains that they earn post that RNOR period can be taxed in India. So this is one way where we can advise our non-resident clients or people having RNOR status, where they can optimize their taxes from an Indian perspective. They pay only taxes in the jurisdiction where the gains are earned if it is taxed. So this is the advantage of why people claim to have an RNOR status. And once the RNOR status is done, then the person will become an ordinary resident where global income will be offered to tax. Even if the taxes are paid in the other jurisdiction, we have to claim them as a credit to the extent is allowed, which we'll discuss later. So coming back to our residential status, so currently there are the basic conditions where if we satisfy, we'll become a resident. Then additional conditions, at least if one of these conditions are satisfied, that person will become a RNOR, post which everyone will become an ordinary resident, post once both the conditions are satisfied. So here I have tried to add some FAQs on residential status or how to evaluate a residential status, which some of us might have been encountered with during practical evaluation of residential status. So how is the number of days stay in India is computed for residential purpose. Generally, if we are looking at the number of days stay in India, what we generally do is we get the passports of the client. We get the passports of the client and we observe the timestamps on the passport. The timestamps on the passport will arrange it in a chronological order and see his in-date and out-date out of India. Once we have that in-date and out-date of India, we'll calculate the number of days stay. The difference between the out-date and in-date, during the period of stay during his presence in India, that is how we calculate the number of days stay. But one doubt which we get is, let's say a person comes in India on the same day and also leaves in India on the same day. Let's say he comes in the morning and leaves in India. Should we count that day as because he stayed for less than 24 hours? So that is one question which we generally get. And let's say in another case where the person has come on Sunday and leaving on the next Sunday, should we take it as 7 days or 8 days? Which means should we include as a date of departure and arrival, both as number of days stayed in India, or we should include only on the date of arrival or date of departure, either of them. So these are some of the questions that we get on how to calculate that number of days stay in India. So for which generally the number of days stay, like I said, is taken from the timestamps. But there are case laws which we talk about, which talks about saying in both, there are case laws for both the cases, I mean both the scenarios. But majority of the case laws say you should not include either of the day, either date of departure or date of arrival. We should not be counting both the days when we calculate the number of days stay. Only one of them, either the arrival date or departure date, should be calculated for the number of days stay arrival. And one more thing is this 24 hours also. So in the act, it's not explicitly said that it is calculated on an hourly basis of day. So the act only talks about the day, which has to be understood in a general calendar year sense. If a person is there even for a part of the day, let's say 3-4 hours of a day, still it is as good as he has stayed in India. Because act doesn't mention that only 24 hours counts as a day. So considering that if a person has come into India, but leaving on the same day, it is still counted as one day in India, even if his number of hours is less than 24 hours, he has still stayed in India for that particular day. Like I said, there is a negative view also, where a Delhi advanced ruling has given a ruling saying that both the days has to be included. However, most of the other jurisdictional courts or ITATs have given a ruling that only one of the days should be included, either date of departure or date of arrival, but not the both. And we have also had this case in one of the scrutiny assessment where we had to defend the residential status of a client. Even there we had got a favorable view for including only the date of arrival, but not the departure, which means we have counted only one on the 2 days, which was accepted by the Commissioner of CIT Appeals. And getting to employment outside India, how is it employment outside India and leaving employment for India, both are covered? Like what is the difference between that? So one is employment outside India means you already have an employment, but they are sending you for a secondment outside India, where you have to work for a foreign counterpart of the same entity. So that means it suggests employment already existing, but you are going for employment to be rendered outside India. So that is one way of interpreting. And the other way is leaving India for employment means where you don't have an employment, but you have got an employment outside India and you are leaving for having that employment. So in section 6.1, it doesn't specifically say which type of the employments are covered, like whether you should already have an employment outside India and only then you can leave, or can you leave actually for the employment outside India. It specifically, since it explicitly doesn't cover, we can actually take a view that both can be taken. Either if you're going for a secondment where you already have an employment with an Indian employer, but they are sending you to a foreign country for rendering services, even that can be considered as a employment outside India. At the same time, let's say you are going outside looking for an employment and you are getting an employment outside India, even that case scenario can also be covered. So both the scenarios can be covered so that that relaxed rule of 182 days can be taken for the person's residential status to be evaluated. However, there was one case law which we found, which is a Kerala High Court ruling, which says that even if you are going outside India for business, undertaking business or starting business outside India, even that can be relaxed for 180 days is a court ruling. However, if this is very litigative stance, if we adopt this, because this is not explicitly mentioned in the Indian Income Tax Act, this was only given by the ruling by a high court. So if we have any clients who are going for business, undertaking business outside India, it is a conservative view not to take that approach of 180 days for them, because that's a very litigative stance, and it was only one such ruling. But I thought it's worth mentioning, so I have highlighted this. So as far as the Act stands today, only the employment outside India is given the relaxation, but not for any other business or occupational related activities. So this one also was what we have talking, where if he is deputed to a foreign bench on case of secondment or for brief period outside India, irrespective of whether the employment is with the foreign employer or Indian employer, but if his employment is of nature where he is seconded by his contract to outside India, then it can be still be covered as a employment outside India. So I've taken one case study where a person uh, being born and brought up in UK, who holds a UK citizenship and he is residing in UK with his family. In July 2017, he moved to India and he is residing in India since then, but he is still holding his UK citizenship and a residential house in UK. And on 25th March 2024, he travels to UK again, and for business reasons, he decides to stay in UK with his family. So he comes back to India on 19th June, makes his arrangements and permanently relocate to UK, and he flies back on 28th August. So in this case, the person is a UK citizen, he has a UK passport, and he is born and brought up there, and his family is also there. But for some reason, he has come to 2017 in India, and he has been residing there, but his UK citizenship is still intact. In March 24, he again decides to relocate back. For that relocation, he has come to India for a brief period and stayed for 2 months. And then he again went back to UK. So in this case, what would be his residential status? So if we look at the basic conditions, in the basic conditions, what it says is, first is either 182 days during the financial year or 60 days plus 365 days during the financial year. So in this case, during 24-25, he has come to India on 19th June and he flies back to UK again on 28th August. So there is a period of approximately 2 months and 10 days which he stayed in India, which means he stayed for more than 60 days in India, and he is not flying back to UK for employment purposes. For business reasons, he is actually planning back to go to UK. So that 182 days rule will not apply here because it is not for employment, and the 60 days rule is satisfied here, and 365 days for the previous 2 years also, previous 4 years also is satisfied here because he has been in India from 2017 to 2024. So in this case, if you look at the basic conditions, the first and second, the second condition is being satisfied. So he will become a resident. But again, a question might come up, since he is outside India at the beginning of the financial year, he has only come into India only during the year, and he has left also during the year. Can we treat it as a person being outside India, coming to India on a visit, whereby I can apply 182 days instead of 60 days? So when we say that a person being outside India, there are two ways I can interpret it. One, at the yes, some question someone else. Okay. So a person should be outside India at the beginning of the financial year. This is one way of interpreting it. The other way is the person being outside India can mean that the person is a non-resident in the previous year. There are two ways of interpretation that can come in. So here's where the strict interpretation of rules come in, where if I actually read the text that is written or that is presented as it is in the Income Tax Act, it says being outside India and coming to India. Residential status is generally evaluated based on a strict sense for a financial year. So if I have to apply both together or read both together, a person being outside India coming to India would mean at the beginning of the year, if he is outside India and coming to India, then he will be treated as a person on a visit to India, and hence not 60 days but 182 days period should be applied here. If I apply that 182 days period, then he will not satisfy the basic condition whereby he can become a non-resident. But if I don't apply that 182 days condition, he will satisfy that first conditions of 60 days and 365 days for previous years, and he will become a resident. The difference between these two is, in the first condition, he will become a resident and he will also become an ordinary resident because he is being staying in previous years. The entire global income will be taxed. In the second condition, in the second scenario, if I take him as a person being outside India but coming to visit in India, then 180 days condition will apply. Only Indian income will be taxed in India and his global income will not be taxed in India. So that is the intricacy here. But if we actually look at his intention to travel outside India, he is trying to relocate back to UK for his business reasons. So his intention is to completely stay outside India, and also at the beginning of the year he has already been outside India also. So it is not a casual visit, it is not a permanent visit where he is, like how I can put it differently is, his visit to UK or his visit to India is only for the purpose of relocating back to UK. So it can be in technical sense seemed as a required visit for him to make the relocation arrangements. But it is not a case where he's been in India but again just visiting UK. It's the opposite scenario where he's planning to completely settle in UK, whereby for that reason he has already been in UK and has come to in India for the visit for his relocation arrangements. So that way, in a technical sense, I can take a stand that he has already been outside India, one on a literal sense, and also from an intention perspective that he is planning to relocate back to UK. Thereby, I can apply that 182 days rule here and thereby consider him as a non-resident for 24-25. Sorry? He is a UK citizen. He is a person of Indian origin also is what I mentioned. Mr. A person of Indian origin, or so the rule says it can be a person of Indian origin as well as Indian citizen. In this case, he is a UK citizen, but he is a person of Indian origin. So, like I said, one is that 60 days condition is satisfied, but being outside condition, if we technically treat him as person has come to visit in India, then that 182 days condition will be applied. If that residential status has been questioned, then he should be able to substantiate with the income tax authorities that his intention was always to relocate to UK, and for that reason only he had come to India. So he should be treated as a person on being visit to India. Even if he has a own place of residence, that can actually be, should not deny his residence status just being because Indian tax rules never say that having a permanent abode in India is an indicator of having residence in India, because that rule is not there in Indian tax rules. However, it has been there in some other global countries' tax rules. So in this case, he will be treated as a resident if he doesn't qualify the additional conditions. However, if we consider him as a visit to India, there he will become a non-resident, whereby he is taxed only on the Indian income. So one more case study which I have taken here. Mr. B, an Indian citizen, has been residing in Oman since 2012. So during 24-25, he has been traveling to India and his number of days stay is around 136 days. Now in 24-25, he has the following income, which is dividend income 7 lakhs, interest from NRE bank account 3 lakhs, and capital gains from sale of shares of an Indian listed entity, which is 6 lakhs. So whether he will be treated as a resident for financial year 24-25. So in this case, he has been an Indian citizen, but residing in Oman since 2012, which means till 23-24, he is a non-resident. We are evaluating for 24-25. So in 24-25, his stay is 136 days. So if we look at his Indian income, it is 7 lakhs plus 3 lakhs plus 6 lakhs. So total is 16 lakhs. So it is crossing 15 lakhs. So he has been a person having Indian income more than 15 lakhs, and he is on a visit to India, where his 182 days condition will not apply. It is 120 days. So since it is 120 days, it is crossing 120 days, and his Indian income is more than 15 lakhs, he should be treated as a resident in India. However, if we actually read that section where it says the Indian income shall be more than 15 lakhs, it talks about the total income. So total income means we should consider the taxable income part. So in this case, that interest from NRE bank account in India, that for non-residents is not taxable in India. So if we exclude that 3 lakhs, then his total income is only 13 lakhs. So which is less than 15 lakhs. So for that reason, he can actually claim that 182 days here and not 120 days. So even if his stay is more than 120, His total Indian source income is more than 15. However, if we look at the total income part, that 3 lakhs will go as an exempt income. So only 13 lakhs will become his taxable or total income, whereby that 120 days condition will not apply and 180 days condition will apply. So in this case, he will become a non-resident for financial year 24-25. So I had got one more case study through which we can introduce the second concept that we are talking about. Before that, if we have anyone has any questions or inputs to share on the residential part which we have discussed so far. Yes. One, right? No, if it is more than 182 days, he will definitely become resident. Yes, because all those are not covered as part of any exceptional rule. If his total stay is 182 days for whatever the reason, then he will be treated as a resident in India, no matter what. Because even if we observe during the COVID scenario, many people who have actually traveled from abroad to India, where they got stuck in India, even in that scenario, government had given a specific circular saying, if it is for the purpose of lockdown where people had to stay in India, then that particular period of lockdown has been excluded for them to evaluate the residency status. But in all the other scenarios, this any such exception has not been given, even if it's for medical treatment or any other reason. Only that as long as it's crossing 182 days, they are by default residents without any exceptions. Yes. Tour operator in India who is traveling, keeps on traveling outside India. So, but if the tour operator is a business that he is running. So based on the business, he is traveling outside India. Even in that case, since it's not employment, like I said, it's the only condition so far that is covered is only employment. Only that Kerala High Court ruling has given, even if it is for business, it is allowed. But taking that stance would be litigative. Like you said, it's a genuine hardship for people who are actually traveling outside India because of the business reasons. But unfortunately, the act is such that it's only recognizing employment as of today. So in that case, he has to manage his stay such that to evaluate his resident status, because that rule of 182 days is not given for people who are actually traveling on their own business. However, in your case, let's say if it is structured in a way where that entity has an entity outside India, where if he is traveling only for one country, I'm talking. But if he is traveling across multiple countries, then again it is difficult. If it is only primarily another country where he is traveling, his employment can be structured in a way that the employment is between both the entities, whereby he can use the 180 days rule. But if it is across multiple countries, then again it's tough to manage that way. In that case, that 180 days will not be applicable for him. That 60 days rule only will be applicable. Thank you, sir. Nice question. Okay, I'll just move on to the next questions. Next topic. So there was another scenario because of which Indian government had come up with an amendment. So the scenario is like, let's say there is a person, Rahul, who is an Indian citizen, but he works remotely for multiple clients. He is like a freelancer who has getting clients from across the globe, where he works for all of them, but he doesn't have a fixed place of working. He travels across the countries and keeps working for the different clients on his freelance basis. Let's say he spends 4 months in Thailand, 3 months in Bali, 2 months in Dubai, and 3 months in Portugal. So if you look at all the respective countries, every country has a way of taxing their citizens or way of evaluating the residential status. But because of his stay is such a way that it's a short stay in all the countries, he is not getting a tax residential status anywhere. So he is kind of maintaining a non-resident status in all the countries, and he is not paying tax on the business income that he is earning in any of the countries. So that way he is able to become a tax-free person because he is not taxed as a resident in any of the country since his stay is being managed in that way. At the same time, all the income that he is earning is not taxed in any such country also. So but only thing is there might be withholdings in some countries if their income is sourced in that country. Some countries may have withholding obligations. Other than that, as such, he is not taxed in a particular country because his stay of number of days in a financial year is managed in a way that he doesn't become a non-resident in any country. So there have been many such instances where people have been trying to manage their stay so that they don't pay tax in any jurisdiction and keep on having a tax-free income. To plug in this loophole, India had introduced the section 6(1)(a), where it is a deemed tax residency. So what it says in deemed tax residency is, a person, if he is an Indian citizen and if his Indian income is more than 15 lakhs and he is also not liable to tax in any other country other than India, then he is deemed to be an Indian resident. So they are looking at all Indian citizens whose Indian income is more than 15 lakhs, but if they are not getting taxed in any other country, then they are deemed like an Indian resident, which means irrespective of their number of days stay in India, if their income is more than 15 lakhs, but they are not taxed in any other country, then they are deemed as a resident in India. So a person who gets deemed as a resident under this subsection, under this section, will be treated as an RNOR, where is a resident but not ordinary resident. Not like an ordinary resident, but they are treated as a resident where they are not eligible for the the privileges or the concessional rates given to non-residents. They have to pay taxes as a resident, but only on the Indian income, not on the global income. Because RNOs are not taxed on a global income in India, they are only taxed on an Indian sourced income. So this particular subsection is primarily aimed at people who are actually working remotely for multiple countries across the globe, where they actually traveling between countries, but they are not getting a tax residency status in any of the country. And there are expats who actually travel from one country to another, but they stay in such a way that they are neither non-residents of that country or neither residents of this country. So people who are all actually falling in these categories, if they are Indian citizens, they are covered under 6(1)(a). So the 6(1)(a), the basic condition is the person should hold an Indian passport. Only if he is an Indian citizen, this deemed residency is applicable. Second is liable to tax. So they should be liable to tax in any other country, which means in a technical sense, they should get a tax residency certificate in that country where if they claim themselves as a tax resident as other than India. If they are not able to get TRC in any other country, then they are again will get covered under this subsection, where they are deemed to be a resident in India, but RNOR. So if, let's look at countries like Dubai, where there is no taxation for individuals, but even Dubai issues a tax residency certificate, even if there is no tax provisions governing individuals. So let's say even if a person is not paying any income tax in the country where he stays, but the country is able to recognize him and give him as a tax residency certificate, that tax residency certificate can still be used, and he can get, he can say that he is not a deemed resident of India, but provided only if he gets the TRC. But there are some countries which are generally called tax havens, where even the tax residency certificates are not issued. But if people go and stay there, where they are not even liable for tax and there is no TRC that they can get from the government, those all Indian citizens will be covered in the deemed residency, where they are deemed as an RNOR in India. Sir, consequences in the sense that, let's say a person let's say a person, this I'm talking of from my practical experience. The last financial year, 23-24, we had a client who had relocated to Portugal. He has been staying in Portugal since then. So we thought he is a non-resident. So when we were preparing his tax computation for advanced tax purposes and all, we were considering all the non-resident rates. India has a tax treaty with Portugal. All the concessional rates under dividend, interest, we have applied that and calculated his tax liability. When we were, if we have to actually claim the double taxation relief, TRC is mandatory when we are filing the form. At that time, since till then he was mentioning as he'll be able to get a TRC there. But for that financial year, he was not able to get a TRC. If he is not able to get a TRC, we can't claim a DTWA benefit. So because of which, all the dividend, interest, whatever income that was taxed at a concessional rate, because he becomes an RNOR, he can't claim the beneficial rates under the treaty. So we had to tax at a higher slab. He was getting taxed at more than, his income was more than 2 crores.
What is the taxability of a resident but not ordinarily resident? That is the first issue. See, today, there are 3 categories that we have. I'm sorry for interrupting you, but I want to clarify this.
Yes.
Today, there are 3 categories. One is a resident who pays tax on his global income.
Yes.
Absolutely no doubt about that.
Yes.
There's a non-resident who pays tax only on India-sourced income. He doesn't have to pay taxes on foreign source income.
Yes.
Now you have this hybrid. That is what I call resident but not ordinarily resident. Is he treated as a resident or as a non-resident? He is largely treated as a non-resident because for a resident but not ordinarily resident, foreign source income is not taxed in India.
Yeah.
With the only exception, in the case of resident but not ordinarily resident, foreign source income is taxed in India if it is a profession carried on in India,
Correct.
which in any case will be a domestic income,
Yes.
or if it is a business controlled from India.
India. Yes.
If you look at your instance, whether he's a resident or whether he's a non-resident or a resident but not ordinary resident doesn't make any difference for the instance that you have covered because he is getting foreign source income, which is not controlled from India.
Okay.
At any cost, that income cannot be taxed in India because he is a resident but not ordinarily resident.
Okay.
Okay? So
got
to
it.
me, this is a stupid legislation which has been brought in by the government of India. They didn't know what they were doing, and then to cover up this, they did something else. Let me be very frank about it. I can say this in any forum.
Right.
They don't know what they are doing. This is an unnecessary regulation that they brought, which is a deem. The biggest problem in this country compared to all other countries is deeming provisions. What they say is, anything which does not belong to anything is mine. To give you an example, let us take a house in Kerala.
Right.
There are coconut trees in all the houses in Kerala. Every house will have.
Correct.
In one instance, a coconut from a neighboring house fell into another person's house. The person in whose house he felt, it is my coconut because it has fallen in mine. India's purpose is like that. If it is not taxed anywhere, but they are not been able to accomplish that purpose because a
RNO.
resident but not ordinary resident does not have to pay taxes in India on foreign source income unless it is a business carried on or controlled from India, which generally does not happen. So to that extent, this is a legislation which has been introduced, which creates a lot of anxiety to people because people don't know how to interpret. That is what my view is. This is what I wanted to explain to people. I don't think we need to pay too much of attention to this because invariably, even if you are considered to be a resident but not ordinary resident, your foreign source income is not going to be taxed in India. Then you don't have a TRC, you don't have a double tax credit, and all those issues does not arise. That's all that I want to make a point, unless you have a different view.
I 100% agree with you, sir. But I want to highlight a case where we faced a difficulty because he was not able to get a non-resident status.
Because even if he does not
No,
get a, this one,
I'll explain the scenario completely. Like I was saying, that person was based on his number of days stay, he is a non-resident. So we are taxing only his Indian source of income. He is getting salary also from Indian employer. He is a very high income earning person where his salary itself is more than 2 CA. So whatever the dividend, interest, income, everything that he gets, which is in India, is generally taxed at a higher rate, which is close to 39% with the surcharge and cess. Now, if we don't get a TRC for him, he'll become an RNOR here, whereby he'll be paying tax at that 39%. But if he becomes a non-resident, with that India-Portugal treaty, they have dividend and interest concession rates of 10% and 15%. So there is a delta of 25% on his interest and dividend income, which proved up to be a huge sum for him. Close to 12-13 lakhs was the difference, or maybe more than that, I don't recall. But because of the TRC that he is not able to get, he had to pay at the last minute the extra amount plus interest, etc. for the short payment of advance tax. But if he was able to get the TRC, then he would have paid at a lower rate in India, only that non-resident roads. In Portugal, he is not paying tax anyways on the foreign sourced income. So he could have essentially escaped with the 10-15% if he had got a TRC in Portugal. Because he was not able to get the TRC, in India he had to pay at 39% instead of 10% or 15% tax. So that was a practical scenario that I observed, like how this deemed residency can in a way increase the tax revenue only on the passive sourced income. When you are talking about the active sourced income, that is very much true. Only there is absolutely no difference between a non-residents and RNOR except for a business managed in India. Otherwise, both of them pay only on the Indian sourced income. This is one scenario where I found this section has a slight applicability, but it may not be the purpose why the Indian government has introduced. It's only a collateral revenue that they are getting.
In any case, what you are talking about is largely exceptions.
Right.
The country does not have to create. The country does not have to create a legislation for exceptions because the number of, what is the amount of income that they are going to earn for these people to spend so much of time, effort and create confusion and anxiety people. That is what is the main issue which I want to highlight.
Yes, even like you said, many of the students who are pursuing, they are also asking like why this RNOR concept is even being there. When in all practical scenarios during their articleship, they only see non-resident or RNOR paying tax on the same income, but not any primary difference. That business managed from India is a very rare scenarios. Unless that RNOR and non-resident are the except same, only this is a peculiar scenario that I observed in few cases.
Essentially, I don't cover resident but not ordinary resident in any of my conferences. I only talk about resident and ordinary resident. These hybrid categories is where the confusion is.
Yes, yes. Sorry for interrupting. No problem, sir. Point taken. Yes. Yes.
For the purpose of filing my tax return in India and if I'm called for an assessment, so what should be the set of documentation that I should maintain?
So let's say you are going to a tax haven for employment purpose.
Yes.
So the documents that you need is one to substantiate your residency status, that you are a non-resident for which your passport on which time stamps, based on that they can see the number of days. Second point is that your employment contract with the foreign country and the visa copy that you have got when you have traveled outside India to prove that the 182 days stay applies for you and not for the lesser stay. Thirdly, you are taxed only on the Indian source of income because if you are treated as a non-resident. So the supporting document for all your Indian income part. Then again, the deemed residency. Let's say whether you are able to get a tax residency certificate outside in the tax haven. If you are able to get the TRC, then you can produce the TRC, tax residency certificate, which mentions the name of the country, period for which you are deemed as a resident in that particular country, all that. You can submit that document also for the purpose of your assessment to evaluate, to basically substantiate that you traveled outside India for employment and you are getting a tax residency or you are a tax resident for a country outside India. Hence, thereby you should not be deemed as a resident and also you are eligible for the non-resident status. But unless you have any Indian sourced income, like what Sir mentioned, that unless you have a business manager in India, it doesn't make any difference for you, even if you are not able to get the TRC, because your employment is outside India. So that source of income is anyways not taxed in India. Any such Indian income only is taxed at Indian rates.
And to prove the intention around staying there on a long-term basis, like because many countries what they do is they issue like a stapled work permits. Like first time when you go there, you get a 2-year work permit and then you can extend it to 3 more years,
Right.
5 more years and like that. So even in that case, by just producing that 2-year work permit, we can prove the intention that we want to stay there for a long term.
Yeah, so intention is not technically recognized in the Act. But however, in the assessments, you can actually prove that also, saying that your intention was always to stay outside India. But as long as you have the documents on that you have left for an employment, they won't even get to the question where the intention comes in. Because if you are managing your stay as less than 180 days. But in a scenario where it is more than 180 days, there it becomes litigative. You might say that this year, by oversight or by practical difficulties, you have crossed that 182 days. However, your intention is to stay outside India for a longer period of time, thereby, so it all gets into the practicalities of how the officer deems it, whether he is comfortable with the point of intention, or should he directly go by the technical reading of the act, where since you have crossed 182, which is even 183 one day also, it should be treated as a resident. So it all gets down to the sometimes the officer's way of approaching the assessment, and if there are officer is understandable of the practical difficulty, sometimes he may give you the relief also. But end of the day, we can't challenge based on only intention. We need we need to manage the number of days stay also to be covered within the law that is written as far as possible.
Got it, sir. Thank you so
Thank
much.
you. Yeah, so these are some brief FAQs on the deemed residency part, where he should be liable to tax outside India, which means it is not essential he has to pay tax liability there, but there should be a tax law governing in that country, and that should cover this individual, where he should be able to get a TRC. So like we discussed, he is deemed as an RNOR, only Indian sourced income is taxed, foreign sourced income is not taxed unless it's derived from an Indian business or profession. So the third topic is dual resident, where a person becomes tax resident of more than one country. So if these are the 4 scenarios where a person can become a tax resident of more than one country, where if his number of days stay is such that he is becoming a resident for more than one country, in that case also he will be deemed as a tax resident in both countries. And sometimes there may be countries which are following a different tax year, and because of the different tax years, it is such that the number of days stay in the both years, if we take that for that overlapping period, he might still become a resident for both countries. One more is the citizenship based taxation. So if you are an US citizen, you are actually required to file a tax return irrespective of your number of days stay in US. So in US, you are taxed on your global income if you are a US citizen, but you are still able to claim the credit, but still you will be treated as a US resident if you are a US citizen. Then because of your employment or business in multiple countries, even in that case also, you can become a tax resident in more than countries. So the issue is, if you become a tax resident in more than one country, then where do you pay tax, or where do you file return? Should you file in both the countries as a resident in tax returns, or should you file only in one country and not the other country as a non-resident? So that's where there is a article in tax treaty. If there is if 2 countries have a DTAA, in the double taxation awareness agreement, there is in the residence article, there is a tiebreaker rule mentioned. If a person is getting qualified as a tax resident in both the countries, then we have to apply certain criteria based on which the residential status of the person can be evaluated to be more leaning towards one country. That country will be decided as the tax resident country, and the other country will be non-resident, and accordingly the other rules will start to apply on the resident and non-resident. So some of the key criteria that is mentioned in the tiebreaker is, first one is permanent home. Like, where does this person have a permanent residence, whether in the country A or country B. If he has a permanent home in a country A, it is more likely to have that country as a tax resident country than the other. And the other factor is center of vital interest. So where his personal and economic ties, which means where his family relationships are there, where his employment is located, or where his investments are there. So these type of factors also do play a role in determining a residency in case of a tie. The other one is habitual abode. So where do they stay more often? Whether it is that one country where they prefer or their intention is to stay more than the other country, then that country would get preference over the secondary country for the residence. And if all the above 3 are not resolved, then it comes to the nationality. So then if it is so, if the person is a resident, national of one country, like citizen of one country, then that country will get the preference. But there are cases where a person can hold dual citizenships also. So in that cases, it has to be by a way of mutual agreement. So the mutual agreement between both countries' tax authorities will determine the residency status. Based on that, in that country where it gets determined residence status, he will become a tax resident. For the other country, he will become a non-resident. Accordingly, all the other income taxation rules, reporting rules will follow to apply. So I have taken one scenario to explain this better. So Ajay, an Indian citizen, works for MNC in US but he spends 200 days in India. So since he is in India for more than 180 days, he will become a tax resident in India. However, US also considers him as tax resident due to substantial present test. So US has the rule called substantial present test, which determines how the tax residency rules for a person staying in US is evaluated. So that has a 3-tier condition where it should be at least 31 days in the present year plus 1/3 of the previous number of days stay in the previous year and 1/6 of the preceding previous year the number of days stay, and all this sum should add up to that 182 days. So by that rule, US also is considering him as a tax resident in that financial year. So by this, he becomes a tax resident for both the countries, India and US. So this is where we should see how the tiebreaker rule will come into picture. So in the tiebreaker, he has a permanent home in US, his job, family, investments, everything in US, and he generally prefers to stay in US. For some reason, he is in India. So because his tiebreaker criteria is inclining towards US, he will be treated as a US tax resident, and he will file his tax return in US on his global income. Whatever the Indian sourced income, he should still pay tax in India, claim that credit in his US tax return. So with this, the first part gets concluded, where we talk about the residency rules and how it is.
I want to supplement to what you're saying,
Yes,
practical
please.
issues.
Okay.
Though, of course, it is eating into your time. See, this is a very, very difficult situation, actually, because today this person has a choice of being treated in the United States as a tax resident or being treated in India as a tax resident, depending on where his income level is higher. So he's a choice of what he has to do because he's an Indian citizen. The challenge is, in this case, if he chooses to be a tax resident of the United States, it's going to be very difficult for him to claim that he's a non-resident in India, because they will say you are a tax resident in India, so you have been having a permanent home. They don't look at any of these kind of issues when you look. There is no form in India which looks at all of these things for you to choose that you want to be a resident. The only criteria that we apply in India for tax residency is these rules of 182 days or a combination of 60 and 365 in 4 years. That is the only combination that they don't know. The Indian tax authorities don't know anything beyond this. They don't even know what this is. And today there is no form that you have practically to claim this. The only form which applies in India is a tax residency certificate. There's a very beautiful case law relating to this particular issue. There was a gentleman who was working in India in a multinational company. He shifted to Singapore because he permanently wanted to shift to the US because he took a job in Singapore. So he became a dual tax resident in India and in Singapore. So at the time when he filed his income tax return, his return was more than ₹1 crore. So he had filed it as a return as a resident. He revised that return as a non-resident because he said, I want to take a residency in Singapore as a tax resident. So to that extent, my foreign source income is not going to be taxed in India. And in any case, the rate of taxation in Singapore is significantly less for individuals. It is about 15%. So it made sense for him to say, I'm going to be a tax resident to Singapore under the tiebreaker clause, but it was a hell for him that he could not do it. The assessing officer did not accept that. He went on appeal to the commissioner. The commissioner also did not want to accept, saying that he is going to be a resident. Even though internationally you have all these provisions, even though India has a tax treaty with Singapore, eventually he went on appeal with the ITAT, and the ITAT said you have a right to do. At that point in time, he produced a tax residency certificate from Singapore, and that was the only saving grace for this. Well, all of this are there in the treaty. India doesn't understand any of these things. The only language that India understands is tax residency certificate. There's only one form. I do not know how many of you have even seen this form. 10F. 10F is the only form which only talks about tax residency. Have you seen any of these clauses in 10F? They don't know ABCD of this. I'm just highlighting the practical issues of, while all of this is there in the treaties and things like that, there are practical issues, particularly if you're a tax resident in India and you want to take a treaty benefit that you're going to be a non-resident. If you take the reverse situation in this case, in the US, if you don't want to be a resident in the US, let us assume in this case he wants to be a tax resident of India because his income in the US is not very high. He can choose in the United States very easily to say, I want to be a tax resident because of these particular reasons. I have stayed in India for so long, I have a permanent home, center, vital interest, whatever it is, they will accept it. And the beauty of the United States, I'm no great fan of United States, but I'm saying that is one of the countries that I'm more familiar with. A green card holder. Do you all know who a green card holder is? Last time in the conference I asked. A green card holder is an Indian citizen, Indian passport holder who has got a visa which is called a green card visa. A green card is basically a visa just like a H1B, L1, B1, like that. In the case of a green card, it's a permanent residency. So it is one step below citizenship. Even if you are a green card holder, you can choose to be a tax resident of India for whatever period that you want. And it will not affect the green card status. So the green card status is something relating to immigration. Whereas the tax residency, whatever you have here, is relating to taxation. So in that country, a green card holder can choose to be a tax resident of India and continue his green card status without getting that affected. That's all that I wanted to supplement to what he was saying.
Thank you, sir. I had one question on the point that you mentioned. So if a person gets a green card, is he under any obligation to surrender his Indian passport?
No, he's an Indian citizen. He's an Indian passport holder. A green card is just a status visa, which gives him a permanent residence. So to that extent, he's one step less than citizenship, but you are an Indian citizen. You are an Indian passport holder. At any point in time, you can give up the green card. But when you give up the green card, whatever applies to giving up citizenship, those conditions apply to a green card. So you will have the exit taxation there relating to green card holders also, which doesn't apply to H1B or L1.
But if I hold a green card, I am still considered as a US tax resident and I have to file my tax return.
US tax resident based on substantial presence. But green card actually, it is not based on substantial presence. If you look at the US residency, you have 4 kinds of tax residents. In India, you have a resident, you have a non-resident, and then you have this hybrid, not ordinarily resident. Now you have another deemed residency. In the United States, you have 4 categories. The first category is citizen. Citizen, there is no choice, you are tax resident.
Right.
The second category is resident alien.
Yes.
Under resident alien, you have 2 subcategories. One is the green card. The moment you are a green card holder, you are a tax resident there. There are no questions about it. Okay. The second category is your resident alien based on substantial presence, just the way you have in India. So there you have 183 days, and then you have over 3 years you have to calculate. Correct. And the last category is the residue category, which is non-resident. So green card holder is basically a tax resident there, but he is an Indian citizen or any other non-US citizen having their regular passports. Green card is issued not only to India, they are issued to all over the world. So to that extent, anybody who is a non-US citizen will be there, but they will be passport holders of their resident country.
Thank you, sir. Yes.
No, so that's an interesting discussion on this tiebreaker thing. But it comes into my mind is that then Section 6 doesn't mention this 182 days exception for the tiebreaker. Because if so is the case, that because one way we read through this 182 is a must and all those things, and then 63, 65, and then there's a tiebreaker comes up, and possibly that's could be the reason why it is the reason of so much of the litigation, because it is not mentioned anywhere, and then it's on the whims and fancies of the Income Tax Department to consider whether it's a TRC or anything.
Yeah, so the litigation actually comes in when you actually satisfy the Indian condition as well as you satisfy another country's domestic tax residency. Only then tiebreaker comes into picture, because tiebreaker is mentioned in the tax treaty. generally your provisions in tax treaty override the domestic laws of the either of the country, which if it is beneficial. It's not mandatory that you apply a tiebreaker, or you apply a tax treaty, but your tax treaty will apply either if it is beneficial to the provisions of the, beneficial to the assessee, as well as if you are actually satisfying the 182 rule and also satisfying other countries' global tax, domestic tax laws, tax residency rules. The reason why tiebreaker is not mentioned in the section is, see, section is part of the Indian Income Tax Act, which applies to the people of India. So there they don't need to mention about the tiebreaker rule. Tiebreaker only talks about if you are resident, if you are a resident as per the respective domestic tax laws, then you look at the tax treaty. But I don't see a point why domestic rules should mention that you should apply a tiebreaker if you already qualify in other country, because nowhere in Indian Income Tax Act they try to talk about the other country tax laws. If it applies, what should be done? That is the reason I think the countries have signed up for the tax treaty to evaluate in case of a tie between any interpretation of provisions with respect to both countries' domestic tax laws. Yes.
No, thank you, that clarifies. Another second point is, there's a lot of OCIs who are working in India now,
Right.
who are being reallocated from US to India on the
Right.
pretext that, okay, the cost is low and that's where we are reallocating you, and they are just providing the services from India to US.
Correct.
Now, they are already more than 182 days in India.
Right.
And because of the tax residency, what they are holding there, okay, there's a dual residency and everything will get applied. But then that 15 lakhs, if they don't have income less than 15 lakhs in India, is there a scenario changes for them, anything or anything needs to be
So
look
let's say
forward
in
to?
case of that OCS, where who are they working for the foreign MNCs from India, I am assuming their income will be definitely more than 15 lakhs. One, that scenario, and as long as, irrespective of their income, if they are satisfying that 182 days condition, they'll definitely become an Indian residents. The only thing is they have to look at the other country also, whether that other country mandates for them to stay or not. Like if it is like in US, where if they are a US citizen but residing in India on OCI card basis, then in US also they have to file the
Yeah.
tax return on the global income. But they have, then in that case, one is you can go look at the tiebreaker because they become a tax resident of both countries. Other conservative scenario or practical scenario, what I have seen people who OCI is working in India are, they file the tax resident return in India, pay taxes here, file the return again in US or the country where they are resident, and claim the credit. So because the Indian taxes are slightly higher than the other country tax laws, they are actually not required to pay any liability outside India. So they are actually paying tax in India to avoid litigation with the income tax authorities. Practically in any scenario, I have not seen anyone going to a tiebreaker extent where because of the citizenship they are getting resident in other country, whereas by number of days stay they are becoming a resident in India.
Okay, yeah.
Dear members, it's a time for tea break. I request you to take 15 minutes tea break.
So
It
let
is
us
arranged
proceed
at-
with the next topics of discussion for the day, which is foreign income taxation for Indian residents and Indian income taxation for non-residents. So I have bifurcated this into three areas, where the first one is foreign income, that how is foreign income tax for Indian residents, and the second one, this is Indian income tax for non-residents and compliance and tax planning for non-residents. Just briefly touching on the rules. So in case of ordinary resident, irrespective of the jurisdiction in which income is sourced, is taxed in India if a person is a resident and ordinary resident. But like we discussed in the first half, if it is an RNO or a non-resident, there is absolutely no difference. Only the Indian income is taxed, any foreign income is not taxed. The only difference comes in where the income is earned from a business or profession which is controlled or set up for India, where the business services are being provided for India, but the entities are outside India. So in that cases alone, if it is an RNO, it is taxed, but if it's a non-resident, it's not taxed. So let us look at how foreign income is taxed for Indian residents. So if it is a foreign salary from a foreign employer. So if it is a foreign employer, whereas the person is in India and he is an Indian resident, then since the employment is rendered from India, it is deemed as income earned in India. So that income shall be offered to tax in India, irrespective of whether it is received in an Indian bank account or not. But generally, if a person is an Indian resident, the income is generally credited to his Indian bank account. Even if, let's say, the person holds a foreign bank account, but the income is credited directly to the foreign bank account by the foreign employer. Even then, since he is an Indian resident, that income also should be offered to tax in India. If it is an Indian employee, it's always taxed. Only in case of foreign employer, irrespective of whether the money is credited to his foreign bank account or Indian bank account, it shall be offered to tax because he is an Indian resident. Global income is taxed. So what is the TDS complaint? Is TDS applicable if a foreign employer pays the salary to the Indian resident? So since income is earned in India, the salary income is earned in India, Section 192 places a responsibility of the employer to deduct the TDS before the salary is paid to the Indian resident. So let's say even if a foreign resident, foreign employer, he is hiring an Indian employee and paying salary to him, they are mandated to get registered in India. They have to get the PAN, TAN, and they should also do the TDS return filing and deduct the TDS, and only post that they should remit the salary to Indian employees. So even foreign employees are mandated to do this. But there is a DTW relief. This is in few cases where if it is a short stay, like the person is a resident in one country, however, he is working in another country for a lesser period, which is specified, which is 90 days in some treaties, 120 days and 180 days in some treaties. If he is staying less than that period, in that country it is not taxed. Only in the country where he is resident is taxed. So that relief is given in case of employer is in one country whereas employee is in another country. But in most cases, if a person is an Indian resident, that income, whether or not it is taxed outside India, it shall be offered to tax in India. He can claim a credit if it is taxed in outside India. If the DTW provides a relief that it is not taxed outside India, then he has to report the entire income and pay the entire tax on the salary income in India. So this is how generally a salary from foreign employers are taxed. In the practical scenarios, what I've seen is there are people who are working outside India with a foreign companies, but because of this remote working or a work from home option, some of them, if they are from Indian origin, they're actually planning to come back to India and work for a period of time, let's say 6 months, 12 months, 24 months, etc. In those cases, one, we should first evaluate the tax residency rules that we discussed about. Second, that employer also should be aware of, once this employee starts working from India, they are mandated with the compliance requirements in India. The employer should get a TAN in India, PAN in India, and do the TDS return filing as long as the employee stays in India. So this comes as additional liability for the foreign employers when their when their employees are traveling from the country to a different country for working jurisdiction. So then what about rental income from foreign property? If you have a foreign property, if you have invested in a foreign property from which rental income is being earned, that rental income is again fully taxed as per our domestic rules. We will only get a standard deduction that we generally get 30% on the rental income, and no other expenses are allowed. One case I want to explain here is, in some countries like Canada, Portugal, etc., you can actually show your rental income there in that country as business income, because there people tend to invest in a property for purpose of earning income itself. So they actually try to show it as an investment property and the income as a business income. But just because that country taxes that income as a business income, for our domestic laws, the nature of income will not change. We should still offer it as a rental income, and we can only claim 30% standard deduction. We can't claim for any expenses that we pay locally there. Only the 30% standard deduction, that is only available if in case of a rental income deduction. It is taxed in the same way how we do for the regular rental income from properties. If it is a home loan interest, that can be claimed only in case of let out. Second one is foreign tax credit. Let's say if that income is taxed in that country, or there is a withholding done on that country, that foreign tax can be claimed as a credit. And then with respect to reporting, this foreign property shall be reported in the schedule foreign assets in the ITR, and also the income shall be reported in the foreign sourced income in the ITR, where the FTC, all that will be have to be reported. And there are few different scenarios where the rental income can be structured. So some places where it is a traditional rental model where we lease out the property, where we get a passive rental income which is shown as house property income. However, in some cases, people actually try to structure it in a way. One is a service apartment where the property is where the property purchase is with the help of a property manager is designed in a way of service apartment leased out to corporates where we get a income. So in that cases, it can then be shown as a business income because for us it is not purely for a residential purposes. It is given to the corporates for them to use it for their business purposes. And the other scenarios such as Airbnb, where we can host the property on Airbnb, where people traveling for tour or vacation can book the property on the platform. And also the income that you get is not generally a rental income. That can also be structured as a PGBP instead of the regular income. In that cases, instead of standard deduction, we can claim the actual expenses that are incurred for the property. And even depreciation also can be claimed in that scenario. One more additional complaints which we need to take care there is GST. Because the person being India and the property is outside India, it can deem as a export of service if you are showing it as a business income, whereby GST compliance is mandatory and we have to file the GST nil rated return if you are getting that income in foreign currency by filing a letter of undertaking.
No services are being rendered from here, correct? The property is outside India, it's consumed outside India, correct? And no services are rendered from India.
But
how will it qualify for GST?
But the service provider is in India. For him, it's an export income, right?
I mean,
For him, it's a export business income, right?
so will it will qualify as an export, though he is, everything is
Everything
outside
also,
India.
because the person is in India, the service provider, the owner of the property is in India. If he has to treat it as export and related, then provided he should get that foreign income also in foreign currency into his bank account. Otherwise, it will again go at interstate trade.
If the income is kept outside India, then also?
Sorry?
If the income is kept outside India, it doesn't enter into India at all?
No, the taxation depends upon the residential. Because the person is in India, even if the income is directly received outside India, since the person is an Indian resident, it has to be offered to tax in India, irrespective of the
Will
bank
there be any
account.
RBI implications bringing the money back into India in 180 days or 90 days?
If you are showing as business income, yes, there are RBI implications. You have to get it within 90 days from the date of invoice.
90 days from the date of invoice. So LUT can be filed with no GST is applicable.
If,
Okay.
it will be a zero rated supply. You
Okay.
just have to report it in your GST returns.
But this RBI thing will come into play.
Yes.
Okay, fine, thank you.
But place of service provider is there. One is, I'll be honest, I'm not very sure, but I've checked this in a scenario where they are actually reporting in GST. That's why I have to mention.
Anybody in the auditorium, they can answer this question.
Yeah, if anyone is actually practicing GST and is aware of this scenario. Should not be applicable. Okay, but because I have seen a case where they are actually following this, maybe on a conservative basis or not, I'm sure. But I've seen a case where they are actually filing this, but they are claiming it as a zero rated supply. Then capital gains from foreign investments. Let's say these are the 4 different types that we get foreign investment related gains from. One is it can be a foreign stock, or it can be a foreign exchange traded fund, and mutual funds or bonds or real estate, sometimes cryptocurrency and virtual digital assets. So in these cases, how does the foreign income tax for Indian residents? So if we look at Indian Income Tax Act, capital gains related taxation, it provides for 12 months if the shares are listed in India. If it is an unlisted shares, then it is 24 months. Currently, all the long-term period is 24 months. It's rationalized by the government last budget, in budget 2024, July. So, but if it is a foreign stock, it's listed on a foreign stock exchange. It cannot be treated as a listed Indian entity share to claim 12 months holding period. Because if you look at the definition under that section 112A and the explanation, it says the share shall be listed on a stock exchange recognized by Securities and Exchange Board of India, which means only domestic listed stock exchanges, if the shares are listed on that, only then you can claim the 12 months holding period. Any other shares, even if it is listed on foreign stock exchanges, then the holding period is only is not 12 months, it's 24 months. So that by that, even the exchange traded funds, even if it is all traded on an exchange, still 12 months period will not apply, 24 months period will apply. Same goes with mutual funds also, because if we look at the definition of equity oriented mutual fund or a debt oriented mutual fund, board prescribes that equity fund should invest 65% or more of its proceeds into listed domestic shares or other equity-oriented mutual funds. At the same time, debt also comes with the same condition. 65% or more of the proceeds shall be invested into other debt funds or domestic debt instruments. By that rule, even all the foreign mutual funds are not investing into India. It will be all investing outside India. For that matter, there are actually Indian mutual funds also, which actually invest into US equities. Even those will be not treated as a equity-oriented or debt-oriented funds. So for all these foreign-related stocks, even the real estate and all these three category of assets, the holding period will be 24 months for it to classify as long-term. Less than 24 months, all will be short-term and taxed at slab rates. If it is qualifying as a long-term, then you will get 12.5% long-term capital gains tax and without indexation. Indexation is now completely removed for all the all the capital asset except for immobile properties. Only for immobile properties, if it is purchased before 23rd July, only then the beneficial provisions can be applied. With indexation 20% or without indexation 12.5%. Even that benefit is available only for residents. For non-residents, even that is removed. For non-resident, literally there is no indexation now. Only for Indian residents, indexation is provided only in case of properties. So now all these foreign investments, for this holding period is 24 months, long term is 12.5%, short term is always at slab rates. Whereas cryptocurrency, it is always taxed at 30% irrespective of their holding period. There is no set off of losses that are available. And 1% TDS, this is a 194S section which has brought in if the transfers are more than 50,000 in a year. In some cases 10,000, where it is the TDS is introduced, but taxation is always at 30%. This is how foreign investments are generally taxed in case of Indian residents. The short-term period of 12 months is generally not available in case of any foreign assets. Yeah, you can take, if there are any losses that you incur in either Indian stocks or if the losses in foreign stocks, if you look at the carry forward and set off of loss provision, there is no mention that it shouldn't be set off within the same category of assets, nothing like that. As long as you have a short-term capital loss, it can be set off against any long-term capital gain or short-term capital gain. If it is a long-term capital loss, it can be set off only against long-term capital gain. They don't give a distinction between it should be domestically earned or foreign earned source of income. Such restrictions are not there in the set off of carry forward. So if you have any losses across the assets, that can be set off as long as you comply with the rules of short-term versus long-term.
Only with the capital gains?
Only with the capital gains.
Not with any other this thing? Right?
No, not with any other head of income.
Okay, any losses by the stocks invested in the foreign traded stocks that can be set off against
So one thing which
against the income of the Indian stocks as well,
correct.
Right? Okay.
One point, actually good question. One point I want to add there is, in case of, let's say you are investing in US listed equities, the reports that you generally get from some of the platforms, some platforms have now been upgraded, but most of the US investing platforms actually provide the reporting based on US holding period, which is 12 months. Whereas the US stocks, for Indian tax purposes, it is 24 months. So if you look at their report, sometimes they say it is a long-term loss. But for us, it is a short-term loss. So we should actually consider looking at the date of transaction of purchase and sell to calculate the holding period as per our tax laws, because the reports that you get from the US investing platforms may say it is long term, but for us it can still be short term. If we actually go by the reports blindly without verifying the holding period, we might offer that at 12.5%. In fact, it should have been taxed at slab rates in our income tax return. That's one extra consideration that we should keep in mind when we are actually looking at foreign income related taxation, especially for capital gains. Thanks.
Thank you.
So far as section 54F benefit is concerned, there is no restriction if it is coming from overseas assets gain, right?
There is no restriction in 54F currently because it only says long-term capital asset. It doesn't say situated in India. That situated in India clause was brought in only for the property purchase. If you are purchasing a property under 54F, only for that condition is mentioned that you can only purchase an Indian property, not properties in Dubai for claiming exemption. But as long as currently the provisions are, it doesn't say gain should be from an Indian asset. It says any long-term capital asset other than a residential house. So if 54F benefit is available, like subject to other conditions of one house on a day of sale, etc., you can claim 54F even for long-term capital gains earned from foreign investments. So the business and freelance income, since they are Indian residents, all the foreign business income, whether it's foreign freelance income, if let's say if you are an Indian resident, but you are going outside, serving that assignment and again coming back, but as long as you are categorized as an Indian resident, you have to pay tax in India, irrespective of which part of the world it is earned. Some additional consideration is, there is FEMA rules that if you actually qualify as a resident as per FEMA rules, you are actually required to receive the money in your Indian bank account. So that is one condition that is under FEMA. GST implication, like we discussed, if it is export of service, it is 0 rated, but requires proper documentation. Same way, PE rules. Sometimes what happens is when we go and stay in a foreign country and do the business activity, there may be a case where you can create a permanent establishment risk in that other country. In that cases, you have to pay tax in that country also, but again, if you are treated as an Indian tax resident, you can claim the credit of the tax paid in that country against the tax liability of a resident country. So that is an additional consideration which we need to keep in mind if we are traveling there and working from there, where the business sourced income gets generated in that country. Yes.
So, I think in the previous part you mentioned that if the person is a resident, it is irrespective of the fact that whether the money gets credited into the India or bank account or whether it remains outside India.
Correct.
But now, so are we saying that this is an exception in the freelance because of the FEMA thing?
No, not exception. Generally, FEMA, see, income tax is different, but as I need to comply with FEMA also.
Okay.
So income tax says whether you receive an Indian bank account or foreign bank account, irrespective of wherever you receive, as long as you are Indian resident, you have to pay tax on the income. Then comes the FEMA question. If the FEMA says that you have to get it in Indian bank account, I am mandated to get it in Indian bank account, because if I get it in a foreign bank account, I will commit a non-compliance under FEMA. But income tax doesn't look at whether you are being compliant with FEMA or not. Irrespective of whichever bank account you receive, as long as your residence rules are satisfied, you have to pay tax in India. But when we are advising clients, we should actually look at from both perspectives. One, we should tell them that if you are either whichever bank account you receive, you have to pay tax in India. But at the same time, if your mandate to get the money into Indian bank account, then you have to actually get the money into Indian bank account, not into a foreign bank account.
Okay, so this is mainly relevant for quite a few people also provide the freelance services rather than being employed, because they also want to get the taxation benefits.
Yes.
So for those freelance people, the expectation is not because of tax, but for FEMA, they need
FEMA
to
purpose.
have the Indian bank account.
Indian bank account,
Okay,
correct.
clear,
correct.
thank you.
Because if, let's say, even if you are selling sometime what happens when there is an Indian company shares that you are selling to a non-resident, the non-resident might say that I would want to pay to you in a foreign currency. If we have a foreign bank account, they'll say it's easier that I'll pay to you in a foreign bank account itself. But if I look at FEMA rules, that sale of Indian shares to a non-resident rules, there it says the money should be credited to an Indian account. In that cases, in the first place, I should try to get the money into Indian bank account only. If not, because otherwise, if I directly receive outside India, as a resident, it is indirectly I have remitted more than $250,000 outside India. That amount will not be tracked in my LRS limit. Any resident person, as per FEMA, can only remit more than cannot remit more than $250,000 in a year. If I am allowed to receive that foreign remittances directly in my foreign bank account, then I am actually breaching my 250. This amount that is received in my foreign bank account is not being tracked anywhere. For that reason, FEMA has given a rule saying you should first bring the money into India. Then you take it out through LRS, and that LRS being tracked through TCS and all the bank reportings. Okay. That is an objective behind why the money should be brought into India first.
Okay, clear.
Hello. Excuse me. So my question about the resident but not ordinary resident case. So a person is coming back to India. So in this year he is a resident but ordinary resident. He sold some stocks in outside India.
Right.
So as he is a resident but not ordinary resident, he is not required to disclose in India.
Correct.
So but the tax is anyhow in developed countries, there is no taxes on the capital gain, US and all mostly, if I'm not wrong.
No, if you are an RNOR, in India you don't need to pay tax on the US stocks. But in US you have to pay based on your US tax laws. But even if he is a non-resident there also, since it's a US sourced income, he is actually required to pay tax provided he crosses the threshold of that minimum income that as per US tax laws.
So can we take it as to the extent of resident ordinary period in India, so any person is not required to pay in India for the global taxation except the business control in India.
Right. So RNO status is not for a part of the year. So once you become an RNO, you are RNO for the entire period. And same way, once you become resident, you are resident for the entire period. If I have to put it in an example way, let's say a person comes to India during July or August, and he stays till March. He'll cross the 182 days period. So he'll become resident. But in fact, he is coming to India only in that June or July period. April to June also he would have earned income outside India. But if he becomes an ordinary resident, irrespective of the fact that the income is earned before he moved to India, he should still pay tax on the first 3-4 months of the period also in India if he is an ordinary resident. Only if it is an RNO, then he'll pay only Indian sourced income tax. So that status cannot be used for part of the year.
As a corollary to his question, that this guy comes to India, has got shares abroad, correct, in the depository account. He sells those shares. He realizes money.
Yes.
So as per FEMA, is he required to bring that money back into and then send it back for investment, or can he invest there only without FEMA violations? I mean, since he become a resident, let's say, assume that he's a resident.
If he becomes a FEMA resident, he has to bring that money into India.
So he doesn't have an option to reinvest abroad, correct?
No, you have an option to reinvest only if you are a, one is if you are a resident and you are sending money through LRS, then you don't have an obligation to bring that money back to India. But in this case, since he is a resident, first he has to bring that money into India.
Okay.
He doesn't have an option to invest outside India directly.
Directly he doesn't have an
He
option.
can't invest outside India, if provided, like you said, if he is a FEMA resident.
Correct.
But even FEMA also actually sees your 182 days period should be seen for the preceding year. Like if I'm evaluating for 24-25, I should see the
Yeah, it
182
goes to
days
the
for
previous year.
23-24.
Correct.
So that way he will become non-resident for FEMA, whereas RNO for income tax purposes.
Okay, there can be two status for the same guy.
Yeah. So FEMA also has a different residential rules.
Okay.
But it's not as complicated as income tax.
Thank you.
Yes. Yes, sir.
But he's not Indian citizen. He can have overseas bank account and receive money over there. Right. He's not a citizen.
Correct.
He's just a resident here.
Right.
So then he can maintain overseas bank account.
He can maintain
and
overseas bank
he
account.
can receive money there and not bring it to India. Only he has to offer it to tax, capital gains or loss, whatever.
From tax perspective, you are correct, sir. But if FEMA, like what we were discussing is in FEMA, if he becomes that resident part, then he has to bring that money into India. If he is a non-resident as per FEMA, but resident as per income tax, like you said, then he is allowed to retain that money in abroad, reinvest, and he is free to do with that money. Yes, ma'am.
A person becomes a resident in India in the current year, but till last year he was working abroad,
Right.
and he has accumulated PF balances abroad.
Right.
So since that is already taxed or whatever non-taxable in that country, when he brings that money back to India, what is the tax treatment? Is it exempt, or?
So for this,
It is
we have to
basically
look
from
at
Singapore, it is a CPF. It is similar to PF, whatever we have in India.
correct. So I think DTW provides a relief for it. If it's a foreign sourced pension fund, and when it is withdrawn, DTW, as per domestic rules, if you see, I have to offer it to tax because it's in the nature of income, but it's not a recognized provident fund as per Indian rules because it is a provident fund not established in India. But DTW provides a relief there that that particular person need not pay tax on that retirement funds.
Okay. Yeah, thank you.
Excellent. So my question about is normally in African countries, where underdeveloped countries, what they will do, the person will go for the employment outside India. So there they won't pay tax on the salary. Normally through other channels they will send money to India, but they are staying there, they are earning there, the amount will be credited to Indian account. So how to treat this one in this case?
Nice question.
It's a practical
Practical
difficulty.
question, I understand. So you are saying the case is the person is going outside India to one of the African countries where he is earning salary income, but he is sending money through other sources to India. And that money you are again taking back to outside India, or it is used in India?
It used in India only.
As long as that money is spent and not invested, I don't think there is a problem. See, the problem comes there is if you invest it, in a person who doesn't have a source of income. Let's say the person sends money to his family and his mother and father invest that money anywhere. Let's say they put fixed deposits, etc. Later, income tax department will question saying, because banks have to report the amount of fixed deposits a person has made. Income tax, if they don't have a filing history, tax filing history, department will send a notice to them and ask to prove the source of income. If they are not able to prove the source of income, then that amount of deposit that they have made entirely will go as unexplained income, where your effective tax rate crosses 80 to 84% now. 60% tax, 25% surcharge, 10% penalty and cess extra. So it goes to 80%. So as long as it is spent, there is no issue. Only if it gets invested and it gets reported, then they have a problem.
So if I want to report in the income tax, how to report? It's like salary income or foreign. That is my.
So it depends upon the materiality of the amount.
Always more than 10 lakhs.
It's more than 10 lakh. Now government has given you 12 lakhs of free limit.
15 lakhs.
I think you should use that as a small taxpayer and hope that there is no scrutiny.
So on this particular part, I understand that a blood relation sending the money to their relative, it is not taxable because what is happening, why? Because a lot of non-resident sons are sending the money to their parents and the parents create the fixed deposit.
Yes.
What our understanding is that if a blood relation money is being sent from outside India, it is not taxable. So are you saying that the question may come up, but still we can give this answer
Yes,
in case of senior citizen as an example?
So in your example, as long as it is coming in a legitimate channels, you
Yeah.
can substantiate.
Yeah, okay.
In his case, I can't give that same answer because they will not be able to prove how the money had come in.
Okay.
They should not prove actually.
Okay, then understood.
You're saying a person is sending money from India to abroad.
Yes, India to abroad.
LRS.
LRS.
Liberalized remittance scheme.
Okay, but if you see there's a 15C and a 15B which has been done, right, for the parent.
Yes. That is for non-residents taking their money out. Predominantly, if you are a resident as per FEMA, only LRS will apply.
So they are a non-resident in India.
Okay.
So probably the son is settled there completely. He's a green card holder and everything. But the parent who is staying here in India is doing the deposits based on her funds and
The funds received from the children.
yeah, not from actually from the children. She's earning the money, and for example, if she's sending it out, so what would be the taxation rule for the person who's staying in India versus to the person who's staying abroad?
So if an Indian person staying in India, if she is sending money to her son outside India, limit is counted under FEMA.
Okay.
So she cannot send more than $250,000 per financial year.
Okay.
But whatever the money that she will be sending is a post-tax paid money.
Yeah.
So it is whatever the income that she earns is already taxed in India. After that only she is sending it. And on that she will pay TCS also, because now TCS is applicable more than 7 lakhs and it's going to be more than 10 lakhs. So that tax credit that she gets, that she has to offset in the tax return that she files.
Okay.
The non-resident, the non-resident relative who is receiving this money, for him it is not taxed in India.
Correct. So it will be taxed abroad, right?
It depends upon which country he is in, because most countries have gift. There is an exemption up to a limit till which the gift is not taxed, even if it is from non-relative. In your case, it's actually relative.
Relative, yes.
It may actually be exempt in that country. It depends upon the country in which he is resident of.
So for example, if the amount has been transferred for the son and the son is not using for investment but using for an expenditure,
Yes.
so it will be different treatment.
No, as long as money is sent out, Indian income tax or Indian FEMA is not concerned about how that money is used in the hands of the relative, because at the point of remittance, I am remitting it for the maintenance of my relative. That is a allowed purpose under LRS.
Okay.
So once that purpose is fulfilled, post that, whatever that person does with that money has nothing to do with the Indian income tax or in FEMA rules.
Okay. Thank you.
So we'll move on to the next topic. which is Indian income taxability for non-residents. So this is a case where non-residents staying in India but working for a foreign employer. So how is it? So if it's a non-resident, if he is getting an salary from an Indian employer, it is taxed in India. But if he is getting a salary from a foreign employer, but if he is staying in India, then that income source is in India. On that also he has to pay tax. But only cases where if a non-resident is not rendering the services in India, but he is receiving that money outside India, in that cases it is not taxable. But again, if the non-resident, even if the services are rendered outside India, but the money is received in India, then again it triggers tax. The reason being, India taxes income either deemed to be arised or accrued in India or received in India. So where it is received in India, we don't need to look at the source. In other cases, we have to look at the source and accordingly offer it to tax. So, but DTWA has a exemption which provides if a non-resident is staying in India for a lesser period of time, in that case, that person need not pay tax in India as long as his period of stay is less than the period mentioned in the DTWA. In some cases, it is 90 days, 120 days, and 183 days. As long as that short stay exemption rules, which says that foreign employees should not have a business establishment in India, and also the person should be getting salary from the foreign employer, as well as the person should not stay more than the number of days mentioned in the treaty. As long as these three conditions are satisfied, that foreign salary is not taxed in India. But in the other cases, as long as he is in India, that Indian income shall be offered to tax. So this is non-residents for rental income from foreign property. See, sorry, this should be Indian property. So if it's an Indian property, he has to offer it to tax. If it's a foreign property, source of income is outside India. If it's an Indian property, it has to be offered to tax. As per the domestic tax rules of Indian income tax, the tenant who is paying the rent to a non-resident shall deduct TDS under section 195. He has to obtain a TAN and he has to file a tax return. They should not go doing the 5% rule under 194, which generally people do. That is a non-compliance. They have to get a TAN number and deduct tax at a high 30% plus cess. For the non-residents, that should be reported under Form 27Q, which is the TDS return filing form. Form 15 CACB should be filed by the non-resident if he has to take this money outside India. Yes. No, payer don't need to file. Payer is not required to file. Payer is paying to the Indian bank account office.
If he is paying to other country bank account directly.
If the payer is directly paying to the foreign bank account. See, it's an Indian income. Again, FEMA comes into picture. You have, if a non-resident is earning income in India, the Indian resident has to pay to his NRO bank account, rupee bank account. So he can't directly pay to his foreign bank account.
So for conservatism, can't we file 15 CA since they are paying?
There is no requirement actually, because one is you are actually prohibited to remit the funds directly to his foreign bank account.
Even in case of paying in Indian account,
there is no requirement. As long as you are paying to an NRO account.
Because some banks are demanding.
There is no harm in filing as such. There is no harm in filing as such, but for the payment of a rental expenditure, 15 CACB is generally not required, because it has to be paid to NRO account. From the NRO account, if the non-resident has to take it back, he has to file 15 CACB and get the money outside India. For him, the limit is $1 million, because he's a non-resident. For a resident to pay, it is $250,000. That is under LRS.
So, in case of sale of property by a non-resident to a resident, the buyer cannot pay the consideration amount to the foreign account of the seller directly?
No, sir. He has to pay to the Indian bank account of the foreign person.
All right.
That's our next case, actually.
So there is no threshold limit, huh? Under section 195, there is no threshold limit, correct?
There
Even 1
is no-
rupee
even
rent
1
you are
rupee
paying,
also you have to deduct that.
you got to deduct tax and then do the
Correct.
compliance.
There is no threshold mentioned.
Okay.
The only thing is that it should be a sum chargeable to tax. Means that income, what he is paying, should be a taxable income in India. As long as it's taxable income, even if it's 1 rupee paid, it should be deducted. Yes. I'm not able to hear it. For TDS? DT. If there is a beneficial rate under DTWA, then yeah, you can take it. But in the so far the cases I have seen, there is no specific clause for rental income as such. If it is a dividend income or interest income, then the DTW will have a beneficial rates 10, 15, 20, 25%. Yeah, so this non-resident, he has to report that Indian property income in the country where he is resident, but the tax that he pays in India can be claimed as a FTC. So this is a question that you asked, sir. On sale of Indian property by non-resident to a resident. So since it's an Indian property, the holding period is 24 months. Once it is held for more than 24 months, then it becomes a long term where the tax rate is 12.5%. Even TDS also is at 12.5%. But the buyer, the resident buyer who is paying to a non-resident, he has to pay the consideration only to his Indian bank account after deducting TDS. That TDS depends upon, one is 12.5%, depends upon the consideration also. If the consideration is more than 50 lakhs, more than 1 crore, accordingly the surcharges also should be applied. Let's say the property is more than 1 CR, the effective tax TDS rate will come to 12.5% plus 15% surcharge and 4% sales, close to 15% overall effective tax rate. That is the rate at which he should deduct and post which the consideration should be paid to an Indian bank account. But if it is a short term, then it is taxed at slab rates, which means the resident should deduct at 30% plus surcharge and cess if it is a short-term property. If it's a long-term property, then it is at 15%. Previously, there was a benefit of indexation for non-residents. In that cases, it was all the more important for this lower deduction certificate, but now the indexation is removed for non-residents. So the 12.5% or 15% effective tax rate is deducted directly on the sale consideration. If the cost is material where the gains are lower, then for the non-resident it's beneficial to go and obtain for a lower deduction before the tax authorities. If not, then they can actually pay tax. If the difference between the TDS and tax liability is not material, then they can actually pay the tax and claim it as a refund if the difference is not material. Only if the difference is material, they can file the Form 13 and obtain a lower deduction certificate before the tax authorities. Practically speaking, in case of lower deduction certificates, the tax authorities will verify the sale agreement. They need a sale agreement to be in place, one. Next, they'll see the property purchase deeds. We should also give them a computation of income of the long-term capital gains and how the rate is lower than the TDS rate. The non-resident should be able to substantiate why it is not beneficial for him to go with the withholding rate on the entire sale consideration, and why does he need a lower withholding tax rate. Once all this is substantiated before the income tax authorities, then only the Form 13 with a lower deduction certificate is given. One more small but key point which people miss is, once the certificate is given by the tax authorities, that rate we should be adding up with surcharge and cess. Most people miss that. Whatever the rate is mentioned in the certificate, they'll directly apply it. But it is not that rate, because this rate is given by the income tax authorities. It is not a rate prescribed in the treaty. Always we should remember that a rate prescribed by the income tax department should always be capped up with surcharge and cess before deducting. But if it's a rate under income tax treaty, that rate is inclusive of surcharge and cess. So when we are going for lower deduction certificate, whatever the rate that is mentioned in the certificate, we should add it up with surcharge and cess and then deduct. Otherwise, there will be a non-deduction or lower deduction miscompliance, whereby we will attract interest and penalties. So this is some basic complaints for non-residents. So they have to file a tax return if their Indian income crosses the basic exemption limit. And Form 10F and TRC, like we were discussing in the first session, Form 10F is required to be filed for them and along with the TRC certificate to make any DTWA claim. And with respect to repatriation, NRE account is treated as a foreign account held by non-residents. It is even if the account is in India, it is as good as a foreign account held by non-residents. So that income is not taxed in India, any interest income that you earn in NRE, provided you should be a non-resident as per FEMA, not income tax. So that is the key there. If you are holding a non-NRE account, you should be a non-resident as per FEMA. So there can be cases where you can be a non-resident as per FEMA, but RNOR as per income tax. So we should be seeing not income tax rules, but FEMA rules, especially when we are not offering income from NRE accounts. The moment you become resident, but if you are still RNOR as per income tax, then you should still offer it to tax. We should not say this is a foreign income and non-taxable. So the key here is, if a person, I mean the non-compliance could arise in a scenario where the person is a resident as per FEMA, but RNOR as per income tax, he should still pay tax on the NRE account interest. But if he is a non-resident as per FEMA, but still RNOR as per income tax, then he doesn't need to pay tax on the NRE interest. However, if he is an ordinary resident, irrespective of whether he is non-resident as per FEMA or resident as per FEMA, he has to pay full tax on the NRE interest income also. So generally the obligation is the vice versa scenario, because what people generally do is, even if they become resident after coming back to India, they generally keep that accounts as NRE, NRO only, because as long as it's NRE account, banks will not deduct any TDS on that, and it doesn't get reported also. So people tend to keep it as it is, so that they can that income gets not reported in your profile and you don't pay tax on it. But there is an obligation on people who become a resident as per FEMA. Immediately after they attain the residential status as per FEMA, they are mandated to convert their NRE, NRO accounts into resident accounts. So the obligation is placed the other way. If a person is a resident becoming a non-resident, there is no obligation on him to convert, but he will only convert because his repatriation limit should go up. If his repatriation limit should go up, he should actually convert it into NRO account. Only then he can take $1 million out. Otherwise, he will be stuck with the LRS where TCS also is applicable. So some tax planning tip is that as long as, like we discussed on the tax residency rules, if he maintains his status of non-resident by maintaining or managing the number of days stay in India, he can maintain the non-resident status or at least RNO status. His foreign income can be exempted from taxation in India, but once he becomes ordinary resident, all his global income shall be offered to tax in India. Any doubts so far? So I'll move on to the next topic, DTWA and FTC. So FTC part I'll just briefly touch upon because we have Krishnan sir speaking in the second half, more in detail on the FTC. I'll just briefly introduce the topics on DTWA and FTC, and then we'll move to that remote working taxation. So generally, why does the double taxation scenario arise? So what happens is, by let's say for India, taxes on base of source, also as well as residence. So if a person is getting taxed in India based on source, but his residence in a different country, then the same income gets taxed in both the countries. And in other scenarios, this, sometimes there may be different people paying tax on the same income. That is also a scenario where double taxation can come into picture. And in sometimes both the countries tax the same income, but they do not get a credit from one country to other country. Even in that scenario also, a same income gets taxed twice. So typically this double taxation is of two types. One is jurisdictional double taxation. Second one is economic double taxation. We'll just understand with case studies on what difference is between jurisdictional and economic double taxation. So in this case study, if we see, there is an Indian company which is paying royalty to a US entity. So as per DTWA, let's say the tax rate is 10%, they're deducting the TDS at 10%. Now this US company has to pay taxes in US because it's a resident in US. They'll pay tax on the same royalty income. This Indian company, that US company, the income is already paid to them after withholding the 10%. So this US company had to file a tax return in India also for claiming that credit. Now if that credit is not given of Indian taxes in the US country, then the same income is taxed in both the countries. So this is a scenario where the income is getting taxed in two countries. This is called jurisdictional double taxation, where the same income gets taxed in two countries. There is another scenario where it is an economic double taxation, which means on the same income, two people pay tax. So if we understand this example carefully, there is an Indian entity which pays commission of 100 rupees to a US entity. 100 rupees commission, in which, let's say, Indian tax authorities, after applying transfer pricing rules, say you should not have paid 100, you should have paid only 80, because the arm's length prices comes into picture. They say 100 is not allowed as expenditure, only 80 is allowed as expenditure. In that cases, the 20 will be added back in the computation of Indian company. On the 20, Indian company pay tax. Since 100 is paid to US entity has to report this 100 as income in US and pay tax on the 100. If we carefully observe, Indian entity is also paying on tax on 20. That same 20 is again taxed in US also. This is because that arm's length price is not met in India, whereas that entire expenditure of 100 is not allowed, only 80 is allowed, which means 20 is getting taxed here also. That portion of 20 is again taxed in US also. Just because India is claiming expenditure of 80, US won't allow 80 as income. There they will say you have received 100, you have to pay tax on 100. But Indian tax authorities won't say you are not given an expenditure of 100, you are given only expenditure of 80, whereby the 20 part is getting doubly taxed. This is a case of economic double taxation. So the double taxation can happen both ways, on the jurisdictional side as well as the economic side. So for this reason, the countries are generally entered into double taxation avoidance agreements, whereby they ensure that income is not getting taxed twice. But one thing which we should carefully understand here is, it is not to avoid tax on both the countries. Objective of DTAA is just to ensure it's not doubly taxed. But if it is not taxed in one country, but the other, you can't say that just because it's not taxed in other country, you will not pay tax in the other country also. So it's not the case where you are not paying tax in either of the countries. The only scenario is you should pay tax in at least one country, but if there arises a scenario where you are paying tax in both the countries, the credit should be allowed in the methods prescribed such that overall tax is paid only once, not twice. That is the main purpose and objective of entering into DTAA. This is generally called as tax treaty also in the commercial sense. So there are two sections that in the Income Tax Act that talks about double taxation. One is Section 90. So Section 90 is a bilateral relief, which means between two countries. If there is a tax agreement or a tax treaty, then we apply Section 90. But if, let's say, there is a country with which India doesn't have a tax treaty, then Section 91 comes into picture, where India allows the tax credit even if it doesn't have a tax treaty with the other country. Generally, these are the two sections that we use in terms of claiming FTC. Section 90 or Section 91 depends upon whether we have a treaty or not with the other country from which the income arises. In sometimes even domestic law itself will be beneficial. We'll come to that a little later. So Section 91, if we see, there should be an agreement with any country outside India or a specified territory outside India. So this relief is generally double taxation agreement is not only for giving the tax relief, sometimes it's also for exchange of information and avoid tax evasion. So what do we mean by exchange of information? We have been practically seeing many of the clients are actually getting notices if they miss to report their foreign income disclosures. But how do income tax authorities get to know that we have foreign assets? Because they get information from the other countries where they collect information of Indian citizens or Indian residents having their foreign bank accounts, foreign assets, etc. In all those scenarios, information is collected by the foreign governments also when we make the investments. That information is exchanged with the Indian tax authorities. They do the database matching and see whether the income tax return reports that particular foreign assets or not. If it is not reported, then they send a notice under Section 131, summons notice, and first they give us an opportunity to explain why we have not reported, etc. But if we are not able to substantiate, etc., then they have a possibility to start proceedings under Black Money Act because we have not reported it voluntarily, where we can come up with explanations on why we have missed, etc. Even if we are able to substantiate that it is not a black money, it's a tax-paid money went outside. See, for non-disclosure, even under Black Money Act, the penalty is as high as 10 lakhs. So it's all the more important that we should report all foreign income, foreign assets more importantly. And I think that is the reason why other income tax departments also been giving us opportunity to file for last four previous years updated return. So if any of our clients have actually missed to report these foreign assets, foreign income, etc., even by oversight, it is an opportunity for them to report now in the income tax and pay the additional tax rather than facing the penalty proceedings. So that is one far-fetched thought of exchange of information and its consequences, how far it can go if we don't have the complaints or reporting appropriately. The other one is prevention of tax evasion, which means at least it should be taxed in one country. So DTAA should not be in a case where the income is not at all taxed in one country, whereby it is taxed in another country. For example, let's say agriculture income. A US citizen is in India and he has properties, inherited properties, where he is getting agriculture income. In India, agriculture income is not taxed. However, US doesn't have any such exemptions on agriculture income. So in US, you have to offer this agriculture income to tax. But when you, not only agriculture income, since he is US citizen, he has to offer entire global income to tax in US tax return. But when he is claiming the tax credit, the credit is not allowed against the agriculture income. The reason is on the agriculture income, you have not paid tax in India. Only on the other income, it is paid tax in India. So in that scenario, that agriculture income has to be taxed at least once. Just because you have not taxed in India, you can't say that I won't pay tax in US. In US, at least you have to pay tax on that. For the other income, you can claim the credit of the Indian taxes paid. So that way, DDW also aims at only taxing the income at least once, but not doubly taxed. That is the main objective of preventing tax avoidance or evasion while ensuring fair taxation. So what are the key requirements for us to claim a DTAA benefit? So one is DTAA is not mandatory. Like if I have an option, so DTAA only provides an option. If the tax treaty provisions are beneficial to you, you can opt for it. If the tax treaty provisions are not beneficial, you don't need to opt for it. And also the other way, you don't need to opt for it just because it's beneficial. If you still prefer paying more taxes in India, we are free to do that. It is not mandated that we need to opt for it beneficial provisions just because it's available. At the same time, for claiming DTAA benefit, TRC is mandatory. Like we discussed, any country where we are paying tax, if the tax needs to be claimed as a credit in the resident country, TRC from the source country is mandatory. We have to get a TRC for the corresponding period, and that TRC shall clearly mention all the details of that country, the period for which it is, all that needs to be clearly mentioned. That TRC has to be uploaded when we file that Form 67 while claiming FTC. So if we are claiming FTC while filing the tax return, before filing the tax return itself, we have to file that Form 67. In that Form 67, TRC is a mandatory attachment along with the proofs of tax paid. So once we attach this, only then we can claim FTC. And this Form 10F also has become online now. Yes, sir.
So this is for one clarification related to the foreign assets, foreign shares. So what is happening is the dividends what they receive, let's say for the US shares, resident, when we file the Form 67, the person will not have a TRC because the person is a resident in India. So there's one clarification we have seen somewhere, which is what I do, is we can mention the PAN number. So because the TRC will not be there. And this is happening for all the US entities in India, where the people are getting the shares and dividends, and they have to file Form 67. So there, this clarification is, I just want to mention. So is this litigative as well? Because I've received the credit for those cases.
Yeah, credit is generally allowed. Let's say if you are not attaching TRC in Form 67, but you once you file Form 10F. In 10F also you can, 10F is actually mandated if you are a non-resident, I mean if you are a resident but claiming a FTC. The 10F also has become now mandatory filing. Previously it was a paper form, now it has mandated. Coming back to your question of Form 67, even if it is TRC is not mentioned, not attached while filing the form, let's say if it is picked up for scrutiny, but by the time if you are able to get TRC for the period, sometimes the relief is still allowed.
Yeah, but for a resident, you will not get the TRC, right?
For the resident, you won't get TRC, for non-residents.
Yeah, for non-residents. Yes,
at the time of scrutiny, if you are able to get TRC, then at least by the time of scrutiny, you should be able to provide with the TRC for them.
Okay, thank you.
So some key questions or FAQs to understand the interplay between treaty and domestic tax laws. So like I said, whether tax treaty provisions override domestic law. Yes, so if the tax treaty provides for something, if it is beneficial, the tax authorities cannot mandate us to follow the domestic rules. They should allow the relief under tax treaty, because that is a treaty entered between two countries and it overrides domestic laws wherever it's beneficial. But if we still choose to opt for domestic tax law, we are free to do that. But if there is something in tax treaty, if I want to opt for it, it is mandatory. The tax authorities should allow for such relief. Yeah, this we cover, like, can tax authorities exempt a taxpayer to apply a tax treaty? No, like, tax authorities cannot force a taxpayer to apply a tax treaty, even if it is future beneficial. That it is always the discretion of the taxpayer to choose whichever is beneficial for him. This is another scenario. Let's say during assessment, initially they say they opt for a tax treaty and they later opt out of it, which is again free to do, saying that at time of, there is nowhere mentioned that once you opt for a treaty, you have to continue with the treaty only forever. The taxpayer can choose to shift from a treaty to domestic laws at different assessment stages. Even if you opt for an assessment using treaty at one stage and later you want to get assessed at a domestic tax law sense in another appellate stage. And this choice again is not a fixed choice. This choice can be made for each financial year in silos. So I can choose for each financial year separately whether I want to go by treaty or whether I want to go by domestic tax laws. So can tax treaty impose additional liabilities beyond what domestic tax law? No. So tax treaties are generally designed to provide only relief, but not just because you opt for a tax treaty, they can, for one article, let's say that is beneficial. For other article, let's say you have interest, where interest is beneficial in tax treaty. At the same time, let's say dividend. Let's say dividend is beneficial under domestic. I can still choose to apply DTWA for interest and domestic tax law for dividend. Tax authorities cannot force saying, because you have chosen DTWA for interest, you choose DTWA for dividend also and pay more tax. That is not allowed. And does a tax treaty apply if the income is already exempt under domestic law? No. Like I said, the objective is to tax at least once, but not tax doubly. So a tax treaty cannot say that just because income is exempt in one country, you don't need to pay tax in another country. That is a domestic discretion to tax an income or not. Tax treaties only comes into picture when it is getting doubly taxed, not only taxed in one country and exempt in another country. And one more important thing is, this treaty benefits are actually subject to anti-abuse provisions also. Like we all know, there is GAR, General Anti-Avoidance Rules, where if a particular arrangement is done only for the purpose of getting tax benefit, that arrangement can be looked through and income tax authorities can make it null and void and leave it in the hands of the respective parties. This will be applicable only if the benefit for all the parties exceeds INR 3 crores. But this is under domestic law. However, this treaty benefit is also subject to that anti-abuse. Let's say we have made an arrangement such that we get a concessional rate in treaty, but if my arrangement's primary objective is only to get treaty benefit, GAR can still apply and deny the treaty benefit during the course of assessment. Even now, even in the GAR itself, I mean the anti-abuse provisions itself are being introduced in the treaties of between many countries itself by way of principal purpose test. So some of the key articles which we generally use for individuals is, one is resident, which we discussed on the tiebreaker, how tiebreaker rule shall be applied when people become tax residents of more than one country. Then other one is income from employment, where we were talking about the short stay exemption, where a person is resident of one country but is working in another country for a shorter period, then the other country shall not tax that income if that short stay exemption condition is satisfied with. Then other few articles are director fees. It is taxed only in the country where the company is incorporated, regardless of director's residence. Here no short stay rule is provided. Pensions, it is also taxed in the recipient's countries of residence, but if it's a government pension, that is taxed in the country that is paying the pension, if it is taxable. Then students and trainees, they are also exempt from tax in the host country. And other income is already is taxed in the country of residence because it is not covered in any of the specific articles. Then the key general clause which is there in all the treaties are elimination of double taxation, which is given by two methods, either if it's an exemption method or a tax credit method. Some of the prominent DTWA where key benefits are given are Singapore, USA, and UAE, which are the predominant countries which we keep seeing, where if you see the rates, which is comparatively much lesser than the domestic tax rates of India. Whereas royalty is taxed at 10, 15, and 10%. Interest is taxed at 10 or 15, depending upon the conditions. And in UAE, it is 12.5%. With respect to capital gains, one interesting point is, so if it is US, it is US, if we read an article of capital gains between India and US, it says that each country has a right to tax the income source in the respective country. But if you look at the other countries' treaties with India, generally it is of 1, 2, 3, 4, and 5, where it says, firstly, it will be saying about immovable properties that will be taxed by the country where the properties are located. And again, it also talks about companies which are deriving their value from the immovable properties, etc. And they also talk about the stocks. But when we read that capital gains article on stocks, there it clearly says it is only from the shares. It doesn't talk about any other capital asset. So that's where the common practice is only if it is shares, it is taxed in the country where it is sourced. If it is other than shares, like mutual funds, bonds, debentures, etc., all such capital gains are taxed only in the country where it is resident, where the person is resident, not in the source. If I have to give an example, let's say a person who is a Singapore tax resident, but he has investments in India. But if his investments are primarily from only mutual funds, debentures, bonds, etc., all such capital gains, he should be paying tax only where he is resident, which is Singapore. So he doesn't need to pay tax in India because of the DTAA benefit. In Singapore, capital gains are generally not taxed, so all such Indian income is not taxed in Singapore also. But if it is a shares of an Indian company where he is earning capital gains, on that capital gains, he has to pay tax in India. That credit he can claim in Singapore if Singapore taxes capital gains. If Singapore doesn't tax capital gains, even the tax paid in India is not allowed as credit because it's not getting doubly taxed. This is a benefit available in case of India, Singapore, India, UAE, India, Mauritius treaty, and few other treaties also. Yes.
See, this is, yeah, if you look at the India-Mauritius treaty predominantly, all the FII money, as it was called then, used to be routed only through, largely through Mauritius and so to some extent by, through Singapore. This particular treaty was changed in 2018 or 2017.
2017.
2017, effective 2018. What did this particular treaty, why was this treaty very important? Do any of you know? Particularly the Mauritius route. Sorry? Participatory notes used to come. What about equity? Do any of you know? You should know. You're all chartered accountants. You can't say, I don't know. That's why I'm asking you this question. Capital gains were exempt where? Where was it exempt? It was exempt in India. Okay. Any other answer? Bang on. It was not exempt in India. The treaty had a special provision. What it says is, in the case of equity instruments, not mutual funds, only equity shares, they said the source of capital gains in the case of investments from Mauritius did not arise in India. It was shifted to the residence country from where it arose. This was the basic issue. That was the reason why you had a large amount of money which used to come. And then you had a lot of litigation, and then that is when this tax residency certificate concept came. Because how do you know that you are a resident of Mauritius? Because invariably all the money which comes from US gets routed through Mauritius and comes to India. That is when they said, no, 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 we have a corporation incorporated, a company incorporated. One building will have some 1,000 companies there. You can't even imagine this. In Ireland, for instance, there is one company which has got 15,000 companies. Okay, that's all accepted. So all this money used to get routed, and then eventually they said, no, this is a company established in Mauritius. That company is investing, so they should get an exemption. Mauritius does not have a capital gains tax regime, And that is the reason why they used to get that exemption in India and in Mauritius. But eventually, when this money goes back to the US, it will get taxed there. It's not that anybody is saving money. It's only that. So the issue was, this was in debate for a long point in time, and no government had the courage to take this issue. Unfortunately, this issue was closed in 2018, right?
Yes.
2018, where they said this particular clause is going to be amended. Whatever capital gains arise in India will be taxed in India. It will not be sourced back to the residence country to that extent. And part of this was also, along with Mauritius, also you had the Singapore, this one. Now there's one issue that I want to highlight about Singapore is, there is a misconception that capital gains is tax exempt in Singapore. That is not true. In fact, I had written to the IRAS, which is a Singapore authority. They said it is not exempt. It is exempt under certain circumstances if you follow certain conditions, and more than 20% of the shareholding has to be held by the Singapore company. It is not automatic. It will be under the scrutiny of the IRS. So because of this particular amendment to the treaty, today you don't have tax exemption for equity investments into India to that extent. There was a huge fear that all the FIs will take away the money and go. At the end of the day, there is taxation for them eventually in the United States. It's only a deferment of that because they don't pay tax in India. They don't pay tax in Mauritius to that extent. It's only a deferment of tax. All the FI money continues to come to India. Maybe there may be some issues relating to it. Now you have, in the case of Netherlands Treaty, for instance.
Yes, I'll put that.
Okay, you want to cover that? Okay, let him cover that.
So like you said, in all the other places, the stocks are covered, but only in case of India, Netherlands alone, there is still that sourcing back to the resident country, provided the conditions is that they should be holding less than 10% on the Indian entity. In that case only, it is sourced back to Netherlands, and the taxes are paid only in Netherlands. In the other cases all, even there also equity shares are taxed in India, and that has to be claimed as a credit only in the foreign country. That is the only country that I could find so far, which is sourcing back to the resident country. In all the other countries, it is predominantly India reserves the right to taxation.
In the case of Mauritius, the rate is 5% for interest. So to that extent, a lot of debt investments are getting routed through Mauritius instead of equity investments to that extent, because the rate of tax is lower to that extent.
Correct. So this foreign tax rate I'll skip because sir is covering in the second session. So the last topic for the day is on the for the session is on the taxation of remote work and digital nomads. So who are actually these digital nomads? So because of this increase in the hybrid work culture and remote working culture, there are companies which are giving people to work from anywhere across the globe. So these people choose to stay in different countries and work for the companies. And many countries are actually encouraging this model by offering incentivized visas and stay permits for different people. Some of the countries which I could gather here is this: Portugal, Dubai, Thailand, Bali, Spain, and Greece, which are giving a nomad visa where, for example, if I look at Portugal, there is no tax for first 10 years if I go and stay under this nomad visa under a regime called non-habituated resident. Only if it is structured, there are some conditions, but if you are able to structure it currently, for the first 10 years, we don't need to pay any tax. But recently, there is some article had come that Portugal is now reconsidering this, that they are going to sunset this by 2024, and they are going to come up with a new tweak to this regime. But predominantly, as of today, it still exists. And similarly, even Dubai also is giving a virtual working visa. There is no personal income tax. It is again coming with a condition of X amount of income. You should be making X amount of income in that country. You should be a qualified professional, and there's defined what the profession is and all. So if you are fitting in that criteria mentioned by the respective countries, those countries offer you a remote working visa. Like you can travel to that country anytime, stay there and work there. And they are giving a tax exemptions and benefits also, subject to certain thresholds and limits. So because of this, people are actually, you can actually not evaluate whether the person is working in a particular country itself or not. So that there can be a taxation challenge for these people Also, if they're between more than one country, on evaluating which country are they resident of. Let's say there are Indian citizens but who are traveling to these countries where they are going under these visas. They have to look at the Indian residency rules like we discussed in the first part, and also look at the other countries' tax rules, residency rules and taxation rules. So what are the prime challenges will be like? One, whether should they pay taxes in the home country or in the country where they are working, or do they become a tax resident in the country? For that, they have to look at the local country's tax rules. And also, can they benefit from tax treaties? Can I actually take benefit under tax treaty if they are actually under this nomad visas? For example, let's say US citizen working remotely from India for a US company. Where do they pay tax? So briefly, we covered this saying if they comply with that Indian residency rule conditions, etc., then they have option to choose it as an Indian resident, but still report this in US because of the citizenship status and claim FTC on that. So these are the current challenges that I see where in respect of people who are traveling across countries and working remotely for companies located in different parts of the world. For the employer, what can be the key challenges if they are hiring a remote working person? So one is permanent establishment. So the person they are hiring outside of the country they should not be doing any such business development activity representing that company such that it creates a permanent establishment for them. So what happens if a permanent establishment risk is created? So to the extent of the business income that is supposed to be earned in the country where the PE is established, that company is required to pay tax, file tax return, report that income in the country where the PE is established. So many companies would not want to do this and they will try to avoid the PE risk, but that is a challenge that they face. So other one is payroll and compliance. Like I was saying, if an US entity has an Indian employee, that US entity is required to get registered under Income Tax Act. They have to get PAN, TAN, they have to deduct TDS for the salary paid to the Indian employee. And if the number of employees are more, then they have to they'll get covered in the social security obligations also. And sometimes they actually try to do this through a contractor instead of hiring an employee. Sometimes they try to do it like a contractor base also. But then they have to take care of the legal complaints. Otherwise, it can be challenging for them on that part also. And in fact, there are some visas which actually prohibit remote working. It depends upon the country. So if the country is flexible enough to give the remote working visa, then it's fine. Otherwise, some visas also may have the challenge on the remote working part. So the relevant provisions is the section 195 where the employer is making payments to non-residents. If this is about the Indian employers paying employees outside India. Then the other one is if the service is rendered in India, that portion of income shall be offered to tax in India because it is sourced in India. And we need to take care of the TRC, DTA benefits and FTC credits also depending upon the residency rules. With respect to employee, they will have like the dual taxation risk that we talked about. They have to take care of the foreign tax credit, determine which country they are resident and which country they should take tax credit. And like I said, if a person qualifies as a FEMA resident, then they have to receive that income into Indian bank account. They can't directly receive in a foreign bank account. And the social security, like if they are working in one country but they are withdrawing, like one of you asked, if a person is a Singapore employee withdrawing PF, whether that will be taxed in India because of the residency rules. So such kind of challenges might arise in case of people working in one country but staying in another country. So some of this tax optimization is to use the DTWA effectively, choose the right tax residence, which pick a tax jurisdiction which is nomad friendly, like the nomad visas that we have discussed, and also structuring their contracts effectively, if not employee through a professional enterprise organization or a consultant mode, where again some other compliances need to be, let's say a person is in India but working for a foreign country, where he is working under consultant arrangement. Then he has to take care of GST compliances, etc. And the number of days stay duration that he should manage such that if he is able to maintain the RNO or a non-resident status. Otherwise, he has to pay on the global income part. We'll cover some key case studies and then we'll get into questions. So this is a scenario where can an Indian tax be offset against both federal and state tax for an Indian citizen who is a US resident? So you will cover this. Okay. This one, sir? This you can. So this we have briefly discussed that a non-resident selling property in India where he's a Dubai resident, but he has a residential property in India, which is worth of 2 crores. The property was purchased 10 years ago for 80 lakhs, but the buyer must deduct TDS before paying the non-resident. So in this case, the tax implication says, like I said, the non-residents, now there is no indexation. So all the properties, there is no indexation, even if it is purchased before 23rd July. So the entire sale consideration is subject to TDS, not the gain part. If we actually look at his calculation, his sale consideration is 2 crores, whereas the cost is 80 lakhs. So he has to pay tax on the 1.2 crores, which is at 18 lakhs. However, TDS shall be deducted on the entire sale consideration, which is 15% on 2 crores, which comes to 30 lakhs, which means upfront 30 lakhs will be deducted from his 2 crore sale consideration, whereas only after the end of the year when he files tax return and gets refund, he'll be able to get the refund of 12 lakhs. So in order to avoid that hardship, he can actually apply for a lower deduction certificate, say that his tax liability is only 18 lakhs, and he can get a rate for 18 lakhs instead of deducting at a higher 15% rate. This is one option where he can reduce his upfront cash outflow, but the tax liability will still be there. In this case, let's say if he's selling the property, but he wants to claim benefit of 54 or 54 EC, he can claim, but even if you are going for lower deduction, that investment shall be made before you go for lower deduction. Because if you just give a declaration undertaking, the tax authorities may not believe and they may not issue the lower deduction considering the exemption. So if we are planning for the exemptions, we should plan effectively and then obtain for a lower deduction certificate. Lower deduction, sir. It takes around, currently it is taking around 3 to 5 weeks. Yes. Provided, like one case where we said we'll claim 54 AC, the officer said, okay, go invest and get me the certificate. Then I'll consider it. But if it's a property purchase, then it might be more hard because I have to purchase the property. Upfront, I'll be left with only 1.7 crores. But since it is 54, I am fine. I have to invest only 1.2 crores. But if it was a case of 54F, I have to invest the entire sale consideration, which is 2 crores. But on hand only, I'll be having only 1.7 if I don't go for LDC. So it gets difficult. But if it is material difference, it is worth going for LDC. If it is not material, then it is not worth the effort to visit income tax departments multiple times. So this is a case where a freelancer earning tax from multiple countries. Let's say he's a proper Indian tax resident where he is taxed on global income. His income from US clients is 20,000 and German clients is both together it's around 25 lakhs. Now the US platform also deducts tax and Germany also deducts tax. So where his Indian tax will be on the entire 25 lakhs of income for which he can claim FTC. That FTC paid in the respective countries can be claimed against the liability in India. There's one, I think I'll just skip on the FTC part because you will be covering, sir will be covering in the detail in the next slide. Yeah, so I think all the case studies are on FTC, so I'll skip them. Any other questions, I am happy to answer. I'll share it. Yes. Correct. He has to deduct under 195. It's a payment to non-resident. No, that person, if he is a US resident, he has to, in India he has to pay tax. That tax only he has to claim in the US while filing his US tax return.
Members, the PPT will be uploaded into the website. You can download it from there.
Thank you, everyone. It has been a lovely audience.
Good afternoon, members. It was a fantastic deliberation on the taxation subject by CA.Varshith Asoori ji. With his experience and expertise in the subject, I thank the speaker, sir, for taking his time out and despite his busy schedule. As a token of gratitude, appreciation on behalf of all the managing committee member of Bangalore branch, I request Chairman, sir, to hand over the token of appreciation. Thank you, sir. Thank you once again for joining us today's seminar and thank for your invaluable contribution. Thank you all the members present here. Now let us take a lunch break and we will sharply assemble at 1:55 to listen our next speaker, Krishnan sir. Thank you all.